This is what it sounds like when doves fly. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. We have a pretty interesting market on our hands. Of course, it was off to the races yesterday, post-Powell. You take a look today, we started higher, and actually we just turned red on the S&P 500, currently off by about 0.1%. You take a look at big tech, currently down about 0.6% on the NASDAQ 100, even though you have that bond rally continuing to build. You take a look at 10-year yields, currently off by about 8 basis points, back below 4%. Some pretty amazing moves there. And I wanted to briefly focus on what's going on in oil, because you are seeing crude come back to life a little bit, currently about 4% higher, Romaine.
Yeah, interesting moves in the market today. It is a bond yield story driving the stock price story. And we should point out here that inverse correlation, it really is something to behold. A 2-year yield now down more than 30 basis points over the last 2 days. A 10-year yield back below 4% for the first time since July. And that's prompting a big rethink of valuations, particularly for some of those interest rate sensitive stocks that had sold off so hard earlier in the year. That includes the meme stocks like a Carvana, like a Sunrun, like a GameStop, rallying hard today. It includes banks like Zions, Regions, Fifth Third, rallying hard today. And it includes precious metals companies, including Goldfields, Freeport, and Newmont, of course, rallying hard on the idea here that the Fed is now out of the way, and they are now the inflation hedge. And of course, we can't forget about REITs. The Bloomberg US 3000 REIT Index, which less than 2 months ago was nursing a year-to-date loss of 14%, it's rallied 25% off those lows and now setting up for what is an 8% gain on the year. Now, while most of the REIT stocks rallying are in the commercial space, think healthcare facilities and offices, residential real estate getting a boost too, particularly with mortgage rates now back below 7% for the first time in 4 months. A 7th straight week where we've seen borrowing costs ease, and that's raising the prospects for buyers who have been sidelined by high interest costs to finally return to the market. And that, my friends, brings us to the underlying issue here. After the clash in recent years with Wall Street traders and the Fed on opposite ends of the spectrum, have they finally kissed and made up here? Katie, are they finally on the same page?
Fighting the Fed. Yeah. It turns out it works sometimes, at least in this latest round, if you will. You take a look at the 10-year yield, pointed out just a minute ago, but really amazing moves. You think about where we were in mid-October, the 10-year yield kissing 5% for the first time in a very long time. We're now a full percentage point below that peak, currently below 4%. You can see that we're nudging up against that yellow line. That is the 200-day moving average. We'll see whether that acts as support here or whether there's more room to fall. But of course, this big rally, this big drop in yields that we've seen in the bond space, it's been great if you're a 60-40 investor. Of course, that combination of stocks and bonds, it had a great day yesterday. Its best day in at least a month, as you saw those twin rallies really erupt. It's a little bit of a different story, Romaine, today when you think about the fact that you have this bond rally continuing, but maybe some of those stock bulls rethinking a little bit. All
right. Well, of course, all of this driven by what we heard yesterday from Jay Powell and the Fed, and more importantly, the dot plots, the projections for where interest rates are going to go. And a lot of people think that that was the mission accomplished sign that the market had been looking for. Let's get to our next guest, who knows more about this than anyone. Jim Grant. He's the founder and editor of Grant's Interest Rate Observer, and he has observed a multitude of cycles over the years. And I have to get your thoughts on this right now, because I know the Fed isn't saying mission accomplished. The market seems to be saying mission accomplished. And I'm wondering if you actually do think this is mission accomplished.
No, inflation, I think, Romaine, is endemic. It recedes, it reappears. It never disappears in a social democracy. And, we're running a 6 or 7% budget deficit at a time of 3.7% unemployment. And the Fed is all too eager, I think, to imply, if not to declare, mission accomplished.
I'm curious as to why you think the Fed needed to even communicate the idea of cutting rates at this stage. We got 5.5% on the high end of the upper bound range. Yeah. And yet we have an economy that, at least for right now, is still relatively stable. Why do you think they felt the need to communicate the potential for three cuts next year? Oh,
if I were to read the mind of the composite mind of the Federal Reserve, I think I would impute this great insight. I think that they would say to themselves, the cost, the unseen but still considerable cost of a decade's worth of 0% interest rates is a great malinvestment, as they say in the economic quarterlies. You know, the white elephants that spring up when money is free. Great doings on the West Coast, up and down the world, venture capital, frontier venture capital, private equity, what have you. So these misallocations of capital, let us call them, misguided because of the false interest rates on offer, introduce an element of frailty in the structure of things. And what the Fed might be thinking is that notwithstanding a 3.7% unemployment, notwithstanding the great looks that you get from the Atlanta GDP Now data, notwithstanding all of that, we don't want to overdo it because of this underlying frailty induced by this decade-long experiment with 0% borrowing cost.
And with that in mind, it feels like Powell started to go down that road a little bit, saying that they're very aware, too, of the risks of basically staying at these high levels for too long. So with that in mind, you think about all these rate cuts that are being priced in and pulled forward for next year. With that sort of psychology in the background, does that make a little bit more sense? I
think so. I think the trouble with the new stance of the Fed, whether explicit or implied, is if inflation is an imposed tax, but not one that's legislated. If inflation is an arbitrarily imposed tax, the chairman and his colleagues are imposing a tax on the possibility of a sustained period of much higher inflation than they had promised us. 2% to me is a very dubious proposition because money is what you get for work, which means money is heartbeats. Money is is what we do. They're not finite. They're not infinite, these heartbeats. And if you tax them through the depreciation of the currency, through a contemplated and intended depreciation of the currency, you are legislating without a vote a tax on the working lives of Americans. So I think as a moral proposition, it's dubious. Milton Friedman would say inflation is always and everywhere a monetary phenomenon. I would say that inflation is always and everywhere a moral phenomenon.
And I mean, with that in mind, you think about the questions facing the Fed right now. Do you think that one of the questions potentially could be, what's the bigger burden here? Is it still high inflation, or are very high borrowing costs the bigger burden? Yeah,
well, I think the Fed, sometimes looks in the mirror and sees Captain Sully landing the plane on the, never mind softly, landing the darn plane on the Hudson River. So the Fed has now arrogated to itself the role of a central planning agency. It now intends, as the chairman said yesterday, we're going to pay more attention to the employment part of our mandate. Well, it's going to try to balance economic growth with the stability and the integrity of the currency. How do they do? I mean, I don't think that is given to mortal man and woman to do these things. And the Fed has demonstrated, I mean, I think I have very convincingly demonstrated to the readers of Grant's Interest Rate Observer that I can't predict the future, but the Fed has unintentionally done the same and without acknowledging the same. However, it is proceeding as if it did have tomorrow's newspaper in its hands, which it don't.
Yeah, well said, Jim. Always great to talk to you. Always bringing a bit of levity here to everything going on around the markets on a crazy day here. Jim Grant, the founder and editor of Grant's Interest Rate Observer, helping us kick you off to the close here on this Thursday afternoon. And in just a bit, we're going to have a conversation here about climate change. The COP28 summit ending with a global deal to transition away from fossil fuels. We're going to discuss what it could mean for the U.S. economy with Ali Zaidi, the chief climate advisor at the White House.
Plus, Costco reports after the bell. We'll discuss what to watch and what those results might say about the health of the consumer. And I had a chance to catch up with Grammy Award-winning singer Patti LaBelle, the godmother of soul, who has now a big food brand that is expanding at a rapid rate. That conversation and so much more coming up in a bit, right here on The Close. This is Bloomberg. Well, President Biden facing headwinds as we approach the 2024 election. That's according to the latest Bloomberg Morning Consult poll, which shows that Trump is pulling ahead across 7 key battleground states. Here for more from Washington is Gregory Cordy. He covers politics for Bloomberg. And Gregory, it looks like Michigan is one of those states.
Yeah, Michigan is interesting to us because in the first 2 rounds of this poll that we conducted in October and November, it was a dead tie in Michigan. Trump and Biden neck and neck, and it was the only state where that it was that close. But now former President Trump has pulled ahead by 4 percentage points in Michigan. We should note that is within the poll's margin of error, although the movement is significant. And the fact that if you just sort of look at the climate across these 7 swing states, they all seem to be moving slowly, but noticeably in the former president's direction.
I am curious about this, and we always have to have a grain of salt here. Polling this early in the cycle always has some semblance of unreliability. But there is an underlying message, I think, once you get beneath those numbers, Gregory, that really jumped out at me. And that was the idea of where Biden is losing support. And I am curious as to why.
Yeah, it seems to be primarily driven by the economy, although there's a little bit of a feedback loop there. Are people saying the economy is bad because the president is unpopular, or is the president unpopular because the economy is bad? It might be a little bit of both, actually, because when we ask people about their local economies, they said the local economy that they experience every day is actually quite good. And that resonates with some of the economic indicators that we've been getting about rising wages, continued low unemployment, and inflation coming down. But in the top line numbers, people say the economy is bad, and that's what's driving down the president's numbers. And it's not that these are Biden voters that are now going to vote for Trump. They're just saying, I'm looking for a third-party alternative, or I might not vote at all, or I'm not sure what I'm going to do. And so what the president needs to do in the coming months is to bring those people from his 2020 coalition back into the fold.
That's really interesting that it's not like they support either candidate here. They're dissatisfied overall. But talk to us about women specifically. You mentioned when it comes to the economy, inflation appears to be a particular concern when it comes to women voters. What did you find there?
Yeah, I mean, this has long been the understanding that just because women do most of the grocery shopping and the clothes shopping in a lot of households, and this continues to be true in the economic data, that women are more sensitive to the prices on those kinds of items. Men tend to drive more; they're more sensitive to gas prices. But what we're seeing is suburban women in particular. They are skeptical of Biden, but they're also saying, yes, they see it. They see the prices coming down.
Yeah, and I can understand the psychology there because, I mean, we can talk so much about inflation coming down in terms of the actual data, but there's so much anecdotal evidence how people still are seeing higher prices, at least relative to where they were a couple of years ago. Another thing, though, that jumped out at me, though, was the loss of support among unions, which I kind of scratched my head about. And we should point out, our story actually features a picture of somebody who has a United Auto Workers shirt for Trump, which seemed odd to me, given how much Biden has sort of pushed into this sort of I'm the most pro-union president ever. And that may be hyperbole, but he's certainly, I guess, given a little bit more action in that space than what we saw during the 4 years of the Trump administration when it comes to embracing unions.
Yeah, just keep in mind that there's a difference between unions, which are the collective bargaining units that they elect leadership and they negotiate contracts with employers, and union members and union households. And what we can measure in polls is the union households. And we've seen just over the past few years that's accelerated in the Trump era since 2016 is union members aren't always listening. The rank and file isn't always paying attention to who the people at the top that they're electing to do their collective bargaining, who they're endorsing for president. And so, yes, President Biden does have a strong labor record to run on. The resolution of the UAW strike a few months ago was good for the president. But union members, just like all employees, all voters, have different issues that they vote on. And so if you're a more culturally conservative union member, if you're anti-abortion, if whatever other issue you are, you may vote for somebody else for president other than the Democrats that institutional organized labor has always supported.
All right, Bloomberg's Gregory Cordy here with the latest Bloomberg News Morning Consult poll here. Basically, about 5,000 registered voters were surveyed in this, showing Joe Biden, the current president, losing ground in some of the key swing states like Michigan to the former president, Donald Trump. Coming up here, we are going to go down to the White House and get their perspective here on the latest COP28 agreement here, an agreement to eventually phase out fossil fuels. The National White House Climate Advisor, Ali Zaidi, up next, right here on The Close on Bloomberg. All right, let's talk about Patti LaBelle. If you know Pi, then you know Patti's Good Life. It was founded by the godmother of soul, Patti LaBelle, the soprano from Southwest Philly. Still singing, still touring, but she's now developed a pretty large food business. It started as a small line of hot sauces 15 years ago and has now turned into a multi-million-dollar comfort food brand offering everything from pies to chicken to mac and cheese. I was able to sit down with her a little while ago to discuss how she got the inspiration for the recipes. Let's take a listen.
From my mother and father recipes. And me and my partners, Charles and my son Zori and Alex, they did all the legwork and went into places, you know, promoting my food. And they got a lot of yeses. Sometimes you get all no's. We got a few no's, but then the yeses outweigh the no's. Yeah.
Were you surprised by the reception to it? Not just in terms of the stores that picked it up, but really the actual customers who ended up buying it.
I was very surprised. You know, because I've always cooked, and that's why my partners, they all ate my food back in the day and said, this should be in the markets, this should be somewhere so people can purchase it, so they can get the goodness that they've been getting all their lives. So when it did as well as it did, I was shocked. I was shocked, but I shouldn't have been, because I knew it was great food. And I knew from my heart, I don't put out anything that's less perfect. So I was surprised but happy, happily surprised, yes.
You mentioned how you wanted to make sure that it was also affordable. Talk about that decision process. I mean, I would, given your celebrity, given the quality of the food, particularly the pies, which I've tasted the pies, some of the other things I've yet to taste.
Do you like them?
But I love them. Okay. I love them. Okay. But given the quality and given your star power, I feel like you could have put any price tag on that and probably still sold out.
I wouldn't have felt good in the heart. I would have been brokenhearted to sell something that I tripled the sales because I'm Patti LaBelle. That's not good karma. You know, so at the prices that they were, and when they started doing so well, I was happy that people who can't really afford some things in life can get the good life from my products because they're reasonable.
So after you finally started to make traction with some of these business, I mean, how long did it take before it really started to take off?
We were blessed instantly, right away.
Yeah. So what do you want to do with it next? What do you want to do with that business?
Oh, we're growing every day. We have new products coming out next year, pancakes, waffles, the powder for the pancakes, syrup, a lot of breakfast items. And every day we come up with new ideas as to what we want to put out in the public for somebody to have, yes.
Now, this has obviously become a big part of who you are, but you are still a musician. You're still a touring musician. I'm told you just got off tour.
Yes, Sunday.
Yeah.
It was the end of our tour for 23. I never stopped touring. And the thing that makes me so happy is that in the venues, they're like sold out with no record in 20 years. So people are still coming to see the Soul Has Been, who does not have a record out, you know? So I'm working on that this year, and next year it'll be out. But I'm just happy touring. I mean, I love to tour.
Yeah, and you jokingly use the word has been, but as I'm sure you know, you're anything but that.
I am not a
and
has
you
been.
have the fan base from back in the day, but you also have a new generation of folks, even though you haven't put out an album in 20 years, that have gravitated to your music, however they've discovered it through streaming or whatever here. I mean, how does that make you feel when you see a 20-year-old or even a 25-year-old say, oh my God, this is...
I question them. I'll say, do you like me because your mother liked me? Or do you like me because you heard me and you said, I like her because I like her? Not because I meet a lot of young folks. My mother is crazy about you. She's this and that. I'm saying, this baby don't have a clue who I am or anything about me. They're speaking for their mother. So when I see them at my show now, I feel wonderful. It's a blessing.
And what do you think of just about the changes, though, in the music industry? I mean, the way artists make money has changed a lot from, the 60s, 70s, 80s to where we are now.
The way they're doing it now, social media. See, I didn't have that when I was working. You're with record labels. These kids have their own music, their own thoughts. They put it out themselves, and they make money. So it's a great thing about social media. The way it's given people a chance to sell their product, to sell them. So that's a great thing.
And that was Patti LaBelle, a Grammy Award winning singer. Of course, Katie, I mean, she goes all the way back to the 60s. Just a wonderful soul singer. It was a thrill to talk to her. But I'm always fascinated by people like this who kind of find these second acts in their career. Obviously, a food business that really kind of started off almost as a joke. And then she kind of had these recipes. And then there was a great viral moment a few years back where someone on YouTube or Instagram sort of tasted one of her pies. And all of a sudden, everybody was like, where can I get these Patti LaBelle pies? And now she's in Walmart, Target, everywhere else, and probably making more money off that now than she is touring.
And still expanding, too. Exciting to hear what pancakes and what else coming
Mac and cheese, pancake mix, a lot of stuff here. But it gets to this idea of, like, how do you sort of extend your career beyond just what you do? And we know the music industry is incredibly fickle. So the idea at 79, she's still touring, that in itself was a testament. But the fact that she's found something else that presumably will live on, well past her, is always interesting.
And you think about, she started this 15 years ago, and now it feels like every celebrity is launching some sort of brand. A lot of singers now are launching skincare and makeup.
I didn't have a chance to ask her about it, whether she was concerned about Ozempic and the GLP drugs, whether that would reduce demand for banana pudding and the blackberry cobbler. But I guess,
do you ever eat that because you're hungry or just because it tastes really good? That's what I want to know.
But cobbler?
Yeah.
Do I just eat it because I'm hungry? No, I eat it because I'm a glutton.
Yeah, exactly. So maybe it's insulated from the Ozempic effect. But next time, your follow-up.
My wife doesn't even keep that stuff in the house because she knows I'll just eat it all like in the middle of the night. All right, stick with us. A lot more coming up here on The Close. This is Bloomberg. This is the countdown to the close, just about 2:30 here in New York. Equity markets, at least in the small cap space, rallying pretty hard here on the day, and a bit of an extension of that Treasury market rally. Let's check in right now on what's going on in the commodity space with Abigail Doolittle and our Commodities Close.
Yeah, well, green on the screen here, Romaine and Katie, for the commodity space. If you think that stocks like a more dovish Powell and a hawkish Lagarde, well, take a look at commodities. The Bloomberg Commodity Index headed to its best day since November of 2022, so more than a year. And this, of course, is the Bloomberg Dollar Index. Declines for a third day, down about 0.8% today. So New York crude up 3%, back above $70 per barrel in a comfortable manner. Natural gas, which has had a lot of weakness to the downside recently, also higher. Wheat, copper, but let's take a look at the precious metals because these are where the real gains are. Gold up 2.5%, platinum up about 5%. Take a look at silver, up 6%, its best day since November of 2022. And then palladium, the real winner, up 15% on the day, its best day since March of 2020. I'm not too sure that anything all that fundamental is going on here, Romaine, except for that weaker dollar and the idea that the Fed is bound or likely to cut next year.
Yeah, I saw that move in palladium earlier. I was kind of scratching my head. Definitely a bit of a technical driven market right now when it comes to the commodities space. Still, there is a big focus right now on what's going on with energy and particularly fossil fuels. The COP28 climate summit ended in Dubai, and there actually was a landmark deal to come out of that. It commits the world to transition away from fossil fuels. 28 meetings, and that's the first time that we've had that actually enshrined in writing. It calls for more countries to make the shift in a just and orderly fashion and to triple the amount of renewable energy like wind and solar power installed around the world by 2030. Ali Zaidi is a national climate advisor over at the White House. He's just fresh off the plane from Dubai. And I do want to start off here just to get an assessment of whether you thought it was a success.
You know, this is a significant step forward. There's a lot of work to do. That was a big part of the stock take in Dubai. There's a big gap relative to our collective ambitions, but we took a step forward in naming the challenges that we face in terms of our reliance on fossil fuels, and then setting these really ambitious targets on renewable energy. At home, we're working to expand our capacity to produce the products that allow us to hit these goals.
I do wonder about the commitment to this, though. It's one thing to put it in writing, and there'll be certain countries, maybe like the U.S., that will move forward in this. Do you have confidence, though, that the other members who signed on to this will follow through?
Look, accountability is a central part of this, and the whole Paris mechanism. The meeting in Dubai really follows on 8 years since the Paris Climate Agreement was achieved. The whole Paris mechanism relies on transparency and accountability from peers and from civil society. So we've got to bring that accountability. But if you look at the scoreboard, the International Energy Agency says we are increasing our deployment of clean energy technologies. That's reducing demand for fossils. So we'll see that demand peak. And I think this gives additional momentum to that trajectory.
Well, let's talk a little bit more specifically about the U.S. and accountability, because as I'm sure you're aware, U.S. production of oil, of fossil fuels has been surging. So if you have the U.S. opening new oil and gas fields, does that betray the pledge in any way?
I think what we've got to focus on is our targets as we look forward, right? 2030, cut our emissions by 50 to 52%. Put ourselves on a trajectory no later than 2050 to get to net zero. And that's got to allow us to meet those goals. We've got to move on a bunch of different parallel tracks. The first, to your point, is we've got to make sure that we're meeting near-term demand. And that's where, you know, we've got to accept the reality of the stock we have, whether it's in buildings, transportation, or the power sector. But we're rapidly turning that stock over to clean energy, whether it's electric vehicles or it's clean heat in buildings or it's solar and wind. So that's how we wean ourselves off of fossil fuels. I think we're doing that in a robust fashion under the president's leadership.
Well, let's talk too about hydrogen here. Of course, we're waiting for Treasury Department guidance for claiming hydrogen production tax credits. Those rules, I believe, we're expecting them next week. They've been the subject of a lot of lobbying and a lot of pushback from the likes of Senator Joe Manchin. What is the guiding mission statement of those tax credits, and how is the administration thinking about some of that pushback?
So our guiding light in setting the rules to implement the Inflation Reduction Act, the biggest investment in climate in the history of the world, is to boost our energy security, to spur U.S. manufacturing, to cut costs for consumers, and to create the certainty that allows for accelerated capital formation and project development. Today, we issued rules on the manufacturing tax credit, 45X. I think that will accelerate things like the manufacture of solar, of wind turbines, et cetera. I think with hydrogen, the goal is the same. How do we not only deploy the availability of clean hydrogen, but really reposition the U.S. to lead on the core technology, the electrolyzers, make them here at places like Cummins in Minnesota, and seize the advantage going into decades that will be defined by this race to supply the world.
What do you make of what's been going on with regards to the adoption of electric vehicle, or really just non-gasoline powered vehicles here? We had kind of this big surge for a while in EV adoption, and that really has slowed for a variety of reasons. But I am curious as to whether you think that some of those loftier goals that people had for production and sales targets of EVs and hybrids, et cetera, whether that can still be met.
I think we're still surging. If you look at where we were in 2021 when the president came into office, we've doubled the number of charging stations that line our roads and highways, and we're on a trajectory to get 500,000 installed. We've doubled the number of models that are available. By the end of next year, we'll have doubled it again to almost 100.
Right.
We've got 10 million EVs worth of battery factories that are going to be in production by 2030. So, you know, if you just look
But
month,
is that a build it and they will come? Because right now people aren't coming. I mean, the prices for a lot of these vehicles are still high. And as you know, there's still a lot of range anxiety. And if you don't live in, say, a single family home where you can install a charger, there's still a lot of people wringing their hands about, if I live in an apartment, can I really have an EV?
Yeah, look, we had a period in the last couple of years because of supply chain issues globally that lithium-ion prices actually flatlined, maybe increased a little bit. This year, we're seeing them come back down again. Bloomberg has done analysis that says that the cost curves will align in just a matter of a couple of years. If you think that's bullish, maybe it's a few years out beyond that. But you pair that with the incredible momentum, I think, that is being spurred by the OEMs. What we're seeing with workers really be part of that transition, the success of the UAW, and then incentives at the state level on top of the Biden tax credit for EVs. I think we're on a secular and very clear trajectory in terms of the deployment of this technology in the U.S. and leading the world on it.
All right, Ali, really appreciate you taking time
Thank
for
you.
us. That's Ali Zaidi. He's the White House's National Climate Advisor. A discussion here about some of those climate goals, not only here in the U.S., but abroad as well. When we come back after the break, we're going to go back to the micro and focus in on Costco. We're expecting to get those earnings after the bell tonight, a preview of what to expect up ahead on The Close. This is Bloomberg. Let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off here with banks. Dick Beauvais over at Odeon Capital turning more positive on a lot of the big banks. That includes Wells Fargo, that includes Bank of America. It also includes names like Truist and PNC, upgrading them to buy from hold. This after yesterday's Fed decision signaled interest rate cuts may come in 2024. Beauvais expects evaluations for these banks to increase as a result. Bank of America representative of what we're seeing in that space, a 6% gain on the day. Next up, let's take a look at Six Flags, getting raised to overweight over at Morgan Stanley, which expects U.S. theme parks to see rapid sales growth next year. The analyst says Six Flags is undervalued and stands to see great benefits from that proposed merger with Cedar Fair. Those shares higher by about 0.8% on the day. And finally, let's take a look at Foot Locker, an upgrade, believe it or not, over at Piper Sandler to overweight. Investor sentiment apparently shifting in anticipation of a turnaround story. The analyst says that's being driven by better inventory levels, and she believes Foot Locker has a great opportunity to expand its operating margins next year. Those shares getting a big boost here on the day, up 10%. And those are some of our top calls. Let's talk about another big mover out there, particularly in the retail space, and that's Costco. The company expected to report earnings after the closing bell tonight, and it's going to be the first quarterly report since its CEO announced he would be stepping down from his role starting in January. Now, under his decades-long tenure, the wholesale membership club, it's outpaced its industry peers. Greg Neal is joining us right now, Senior Managing Director over at Evercore ISI. He's got to outperform on Costco, and I see why, Greg. I was actually going through the numbers here on the equity performance under the CEO, and really even prior to he got there. I mean, we're basically talking about 20% annualized returns when you average it all out over the past couple of decades here. Is that going to be the growth story going forward once he's gone?
We think there's a lot of opportunity for Costco, and it started from the founders, Jim Senegal, Jeff Brotman, right on through to Craig's leadership. And it's really about the unique, shocking value that Costco brings its members. So we think there's still plenty of opportunity. We look for a pretty good print tonight. Expectations are high, to be fair, but as long as they keep growing traffic at 3 to 4% in the U.S., we think there's still plenty of room for Costco to grow.
I am curious. A little bit earlier this year, when we were covering Costco earnings, we were talking about this idea of a recession and how companies like Costco usually tend to benefit from that as wealthier people trade down and the lower income people basically get even wedded more toward that space here. Is that still going to be a narrative that we need to be focusing on, or has that shifted heading into next year?
I think that the consumers are always focused on value and quality, and we don't see a lot from our survey work that's really changing. You have is a slowly decelerating consumer as they make choices based on all the inflation they've seen over the last couple of years. And in the case of Costco, that's going to be a great place to buy what you need to do and splurge every now and then on things that you might not need but want. And do it in a way with still saving money. So we think Costco is well positioned for the type of macro environment to next year, particularly given that shocking value that they bring their members every day.
And Greg, on the topic of inflation, of course, Costco reports just about a month after we heard from Walmart's CEO saying that they see the potential for deflation in the coming months. Would you expect to hear anything similar from Costco this evening?
I would. I think Walmart sort of said, if you look at the whole store, they're sort of flip a coin as to whether we could have deflation or inflation in the coming months or quarters. I think Costco will sort of say something similar. Basically, food and commodity foods are deflating, if not already. And it's really, as you go across the store, some general merchandise areas have already been deflationary at Costco. It's really a lot of the consumer packaged goods and anything that has some sort of labor or service in it that still has some low single-digit inflation. So, again, I would expect disinflation out of Costco. We'll see what they actually say in a couple hours as to if it actually got to the zero or not.
Does it matter that the revenue growth rate has come down so much, Greg? I mean, we were kind of in double-digit growth rates for a long time. I know they've kind of moderated down into the kind of the mid-single digits here. And just looking at analyst forecasts, that seems to be kind of the area where they see this company going, at least for the next 3 years.
Yeah, I think that's why we focus so much on membership growth and traffic, because if they get comp store traffic and have more customers, those customers that are coming more frequently, they're members, right? And they're likely to renew. And those renewal rates of 92% plus are sort of an all-time high. The millions of members that signed up during COVID really seem to not only just renew, but they actually upgraded the executive membership, which is now over 40% of the members. So I think people are self-selecting a fee hike by doing the executive membership because they really do see the value in it.
All right, Greg, always great to talk to you. Greg Milish over at Evercore ISI, a closer look at Costco. We will have full coverage of those results when they cross the wire later tonight after the bell. Stick with us. A lot more coming up here on The Close, right here on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. David, taking a closer look at real estate, which we should point out, real estate stocks, at least today, are on fire on the back of that Fed meeting yesterday that saw rates come down.
Who can blame them? But they had a fairly rough 2023. So the question is what happens next year? And to answer that question, we welcome now Lauren Hochfelder. She's Morgan Stanley Real Estate Investing co-CEO. Lauren, thank you so much for joining us. Welcome. So we did have a rough year in real estate in 2023, as Romaine points out. Coming back now with Jay Powell's encouraging remarks, what are you looking for in 2024?
Sure. Well, we invest in real estate on a global basis, and we've been at this for 30 years. We find this opportunity, honestly, amongst the best we've ever seen. So we're seeing deep distress in the toughest real estate assets, but really what's more interesting is dislocation across the board. So to see how different real estate assets are going to behave, you really have to start with what real estate is, which is a function of how people use space, how we want to buy goods, where we want to live, where we may want to go to the office if we ever go back. So we really start there, and we think there's going to be just wide bifurcation based on these shifts in how people are behaving.
So when you say dislocation, I think about issues in the market where there's some things that you could buy cheap. If not cheap, at least things that will grow beyond where they are now. Where do you see those opportunities?
Sure. Well, we really want to be behind those long-term mega trends that are shifting behavior. So we start with industrial. So the last 10 years in industrial has been all about e-commerce growth. That's a trend we identified early, and we started buying and building those warehouses that get goods to our front doors. And that's been an extraordinary opportunity for our investors, as assets over the period we've been investing have doubled and tripled in value on an unlevered basis. We think there's still a little room to run there, but beyond that, we're seeing two more trends really driving demand. So the first is a supply chain overhaul, which we're seeing on a global basis. And, really we're seeing companies diversify their supply chain. They learned the hard way during COVID. You can't put all your eggs in one basket. And they're feeling pressures around deglobalization, geopolitics, et cetera. So that's creating more aggregate demand, and it's changing where that demand is with winners and losers.
I am curious about other parts of the commercial space. We've seen a lot of interest in healthcare type facilities. That has done pretty well here. Have you ventured down that road, and if so, to what degree?
Yeah, absolutely. Yeah. Well, if you think about the U.S. in particular, what is it? It's millennials and boomers, and the boomers are aging, and that's creating different needs in their real estate. So we're seeing increased demand for senior housing. That's a big driver. We're seeing increased demand for medical office. And we think the amount of spending going into healthcare is just increasing exponentially, and in turn, the need for healthcare-oriented real estate is growing. So yes, we're very active in that space, and it's been a great opportunity.
I do want to get your thoughts here about interest rates. We know, at least in the market, interest rates are already coming down, and most people expect Fed interest rates to come down at some point in the near future. Earlier this year, all the talk was about this sort of refinancing cliff, particularly when it comes to commercial and office properties, to be very specific here. I'm wondering if you see maybe a little bit more of a light at the end of the tunnel in this whole saga, that if interest rates indeed are truly coming down, does that take some pressure off some of those properties and some of those, more importantly, some of those owners who really were facing that refinancing cliff?
Yeah. Look, it depends on how much they come down and how quickly. So when you're looking at $1.5 trillion of real estate maturities, real estate debt maturities over the next few years, and a whole wall of corporate maturities as well that may trigger activity in real estate land, I think the opportunity set is still really there. So there's simply a pullback from lenders. You look at the traditional banks, whether it's the large banks or the regionals, and the reality is they're trying to reduce their commercial real estate exposure, whether for regulatory reasons or other, and that creates a deficit, that creates a capital need, which should catalyze selling, recapitalization opportunities, opportunities to provide structured finance, et cetera.
You talk about the supply chain, the changes there. Does that mean in the United States? Does that mean in Mexico? We have some people saying there's opportunities in industrial in Mexico, nearshoring, or is it all of the above?
So it's all of the above. So the U.S. is a huge beneficiary of obviously the nearshoring and reshoring trends. So we're bringing manufacturing back here to the U.S. That's great for U.S. industrial. Manufacturing in Mexico is also great for U.S. industrial. So we've been investing along the southern border for quite some time, and there's real demand there coming out of that manufacturing in Mexico. We're also seeing demand in places like India. So as manufacturing diversifies away from China and into India, that's been great. We own a lot of industrial in India. And frankly, that shift to India even creates or shifts the demand in the U.S. because when you're importing goods from China, it's coming into the West Coast, and when you're importing goods from India, it's coming into the East Coast ports. So lots of change.
We were talking about commercial. What about residential?
Sure. Look, residential, you have to bifurcate by region because it's really different. So the U.S., it's really all about the millennials who are growing up and growing out as they reach peak household formation years, and the boomers who are growing older and changing their needs. It's different in Europe, where frankly rents are much more regulated, and it shouldn't surprise anyone that when you suppress rents, you suppress supply. So what does that mean in Europe? It means the income streams feel really durable, but you can't grow them. So from our standpoint, what that means is you need to get in at a really attractive yield, a really attractive entry point, and we're finding opportunities to do so. So you mentioned REITs early on. The public real estate companies in Europe are about 2 times more levered than they are here in the US, so that catalyzes opportunities. Then you go to Asia, and look, rented residential as an institutional asset class really only exists in Japan. And we think Japan's really interesting, and we've been investing there. So you're seeing the positive effects of healthy inflation. I mean, we've been investing in Japan for almost 30 years. We've been making money through that period with no growth. So having the growth at our back, that is really exciting. We're seeing rental growth on our residential portfolio 10% plus over the last couple of years. That is something that's been unheard of, and that's really exciting.
Lauren, really great survey of real estate. Appreciate you being here. It's very helpful. That's Lauren Hochfelder. She's Morgan Stanley Real Estate Investing Co-CEO. So I keep hearing this. Japan is coming back.
Yeah, it
How
is,
about
David.
That? Wait long enough.
You have to wait long enough. Yeah, sure.
Everything comes back sooner or later. Tomorrow we're going to be joined by Sam Palmisano. He's the former IBM CEO on the just launched American Frontiers Fund. And tomorrow evening on Wall Street Week, we'll hear from Glenn August, Oak Hill Advisors, founder and CEO, on the growth of private credit. That's coming up Friday at 6 p.m. New York time, Romaine.
All right, a lot of great conversations coming up on Wall Street Week, and you can catch David every day around this time, right here on The Close, as we round out into the final hour of trading here on this Thursday afternoon. A bit of an extension of the rally, of course, that really got a little bit of extra fuel yesterday on the back of that big drop in yields. A big question here, how much of this is driven by technicals, how much by fundamentals? That conversation coming up after the break, right here on Bloomberg. It's just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
We talk about an extension of the rally that was, well, I guess you can say it started yesterday, but if we want to be honest, Katie, this actually started a few weeks ago. And I think yesterday was just kind of the cherry on top with the Fed kind of giving that mission accomplished sign that everybody was hoping they would get.
Giving the green light, and that really paved the way to a huge day yesterday, not just in stocks, but in bonds and commodities as well. Really everything rallying. Bonds are still rallying. It seems like equities, some of that euphoria is fading a little bit. But like you said, this rally has been several weeks in the making at this point.
The S&P right now sitting just about 80 points away from its all-time high. The Dow closed at an all-time high yesterday. The NASDAQ 100 traded at an all-time high today. And the Russell 2000, that's the big differential. That is the big outperformer. If you're looking for a broadening of this rally, that's where you're going to see it today. And of course, a lot of that has to do with what you see at the bottom of your screen here, a 2-year yield. Only down 3 basis points today, but you add that to what we saw yesterday. Remember, we were at 4.748 just a week ago. A 10-year yield now below 4, and you flip up the board. Mortgage rates, Katie Greifeld. I don't know if you're in the market, but now back below 7%, which I guess is a bargain.
I gotta say, perpetually in the market, that's still not good enough, but a lot better than where we were.
Yeah, absolutely.
All right, let's talk about some of the individual movers today, because a lot of moves under the surface. I want to start with Moderna. Huge day for Moderna. New study results coming out that's showing that a new vaccine developed with Merck by Moderna as well. It cut the return of severe skin cancer by half. Specifically, patients with severe melanomas who got this vaccine in combination with Merck's cancer drug were 49% less likely to die or have their cancer return. You add it together, this is great news for Moderna, of course, trying to expand beyond just its COVID products.
Yeah, you haven't seen a move like this in a while. Remember Moderna used to move like this every single day?
I know. So I don't know, maybe light at the end of the tunnel here. Let's move on, though, and talk about Adobe. Of course, these earnings broke yesterday. Post-Fed, you can see Adobe not having a great day here. It delivered a disappointing outlook. Revenue going to come in a little bit light next year, below what analysts were looking for. This is particularly a letdown since Wall Street had really high hopes for Adobe's AI tools. Maybe it still does, but it had fueled an 85% rally through yesterday's close. But the message yesterday was that monetization, maybe it's going to take a little longer.
It's just not there. I mean, all you had to do was look through that release. I mean, ignore what the executive said on the call. It was all right there in the numbers.
Yeah, let's move on. Let's talk about Ford. I don't have a good reason here, but it's hard to ignore the move in Ford right now. Shares absolutely surging. You can see they're up almost 8%, call option going crazy as well. Again, don't have a good fundamental reason here, but I will note this is the best day for Ford since October 2022, so we'll continue to keep an eye on that one.
Yeah, a lot of this does seem to be tied to the drop that we're seeing in rates. The idea here that financing the vehicle maybe just got a little bit more easier, and whether that gives a boost to Ford, but you're seeing a lot of folks in the automotive space get a strong bid today, as we are just about 58 minutes away from those closing bells. Our cross-platform coverage, it starts right now.
countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Tim Senovic, Emily Grafeo in today for Carol Master. Welcome to our audiences in full across all of our Bloomberg platforms, television, radio, originals, and our partnership for those folks streaming on YouTube. A bit of an extension of this rally, though I do think the interesting things, Tim, about the extension of this rally, that it really is kind of leaving the big caps behind, and this is all about the small caps and cyclicals.
Yeah, it's broadening out a little bit. We're actually going to be speaking with Abigail Doolittle all about that in just a few minutes. I'm also keeping my eye on the bond market because we're seeing the 10-year fall below 4%, and in fact, earlier it was below 3.9%. And that got me thinking about mortgage rates, and the good news for us is Thursday is the day that we get an update on what mortgage rates are doing. And here in the U.S., mortgage rates have finally slid below 7% for the first time since August. 7% is, here's my question, like that's a big deal, but at the same time, it's higher than the average over the last decade, significantly higher. And Emily, I wonder if it's actually going to move the needle and get people who are, sitting on these 4% mortgages to say, wait a second, okay, now I could be selling my house and getting more inventory on the market because this market's just been in a real stalemate.
That's right, Tim. I mean, we talk about a loosening in financial conditions, and to see these mortgage rates come down, it is really an example of that. But you're right. Is this really going to move the needle on supply? If we do have more demand coming in as more buyers step into the market because those rates are lower, is it actually going to cause those people who are locked into those lower mortgage rates to actually sell their homes, Romaine? That's still unclear if this really is going to provide any relief for the housing market.
Well, I mean, I've shown a chart to our TV audience before we came to you here that kind of showed the differential between where mortgage rates are right now at basically about 7% and the effective mortgage rates of all the mortgages that are outstanding. That effective rate is still right around 3.1% here. So that's what a lot of folks are going to have to contend with, that if you're sitting on a home right now, you're basically paying on average probably in that 3% range here. Do you want to swap that out for 7% mortgage?
No.
6%?
No.
5%?
No.
4%?
Keep going down.
Okay.
I think you want to swap it out for
Tim ain't going for
3.1%
it and getting out of
mortgage.
bed for anything above 3%.
Yeah, I mean, I think here's the other problem, though, is that when mortgage rates go down, typically, this is typically the way it works. It's not the way that it's worked out over the last couple of years. But when mortgage rates go down, houses get more expensive. When mortgage rates go up, houses get less expensive. We haven't seen that happen because of that lock-in effect that you're talking about, Romaine. So I don't see what gets the housing market out of a stalemate.
We need to move on because we have something really important to talk about, and that's what happened at Newark Penn Station today. I'm sure
You're
you
just
guys.
from New Jersey, Katie, so you want to talk about Penn Station.
This is a global story. This is a global story, Tim. There was an actual live bull that was released on the tracks. It was loose on the tracks. It's since been recovered. Let's get that out of the way now. It's been contained apparently inside a fenced lot, but this was incredible. I thought it was a joke at first. It just seems a bit on the nose, of course, after the Fed and the big rally that we saw that we had a bull running loose in Newark Penn Station. But this was real. It's unclear where the bull actually came from, but as you can see there, it is safely in a trailer.
What do you mean no one knows where it came from? Did no one know that they were missing a bull? Because they're pretty big. I feel like if the bull is gone, you would kind of notice that.
I'm sure that someone is trying to reconnect with their bull.
I'm confused.
Right now.
So they put this into a back of a truck here, and I see we have helicopter footage.
Oh, you have to.
This is like the OJ chase all over again.
Yes.
But I'm curious, could they not have just put them on like a New Jersey Transit train?
No, definitely not. Did you see the horns on this thing? I mean, I want to know what its wingspan is because it's a beautiful animal.
Okay, well, given the bullishness that we've seen over the last 7 weeks in equity markets. Animal spirits. It's a lot of bull. That's pretty much just kind of makes sense. And I think one of the reasons why people couldn't take their eyes off of this. But really, it's the fact that it's a bull running loose in New Jersey.
It's all I want to talk about.
Yeah, I know. And, I didn't want to talk about it, but you won, Katie, and we got to talk about it. So, Romaine, did you want to talk about it?
No.
Okay. You didn't? Okay.
Cool.
There we go.
I wanted to talk about it.
Emily wanted to talk about it.
Thank you.
There's
I guess the big question, which none of you have answered here, are people going to be able to get home tonight? Is the bull's gone?
They're not going to be able to get
back
home.
and running? For New Jersey Transit, that means are they running as slowly as they would normally run?
New Jersey Transit said in a tweet, service is operating on or close to schedule with residual delays.
It's still New Jersey
residual
Transit.
Delays.
Residual.
It's still New Jersey Transit.
Do they just dust off the same statement every day, I assume, right?
Yeah, they too.
Yeah.
Hey, we got to go, but don't worry, we're going to be back together, all four of us, a little bit later in the program, live on TV, radio, and YouTube. Also on Bloomberg Originals, 4 p.m. for Beyond the Bell when we take you through today's market close.
And we continue our coverage right here on Bloomberg Television, counting you down to the closing bells, just about 50 minutes away here on this Thursday afternoon. Sonal Desai joining us, CIO over at Franklin Templeton Fixed Income. And Sonal, fixed income, you've been the star of the show for most of the year here. Is it over? Is it over for you guys? In all seriousness, we talk about this big move down in rates here.
Yeah.
Is this the trend line now that we should now start positioning for a continued drop in rates?
So, that's a really interesting question, because if I look at what Fed Chair Powell did yesterday, he did something which I thought was fascinating. The market was already moving. It's completely unclear why he decided it was necessary to turbocharge the move, but he did. He definitely turbocharged that move. So at this point, we're racking up. The market's counting on more than 150 basis points of rate cuts next year. The Fed told us they increased their expectations to 75. 150 is a significant amount more. Unfortunately, I don't think this is the beginning of a sustained move downwards. Without a doubt, rates are not going to go all the way back up. And I actually thought they would go back up, but the Fed is in a very dovish frame of mind and has indicated they want to cut rates. So I would say the volatility is not entirely behind us. This move happened far too quickly. I don't think this is the beginning of that sustained move lower. But I do think, in general terms, rates are going to move lower. There is no doubt.
I am curious, though, about how you interpreted the reasons behind why the Fed would communicate basically 3 rate cuts, and the reasons why the market is pricing in, whatever it is, 4 or 5 rate cuts here. Is it for the same reason, or are they kind of not really on the same page?
I'm not sure they're fully on the same page, and it's not 4 or 5. At this point, the market's kind of discounting 6, right? Unless they're talking about larger than 25 basis point cuts, which is also possible. Now, I think it was just that Powell's statement was so incredibly dovish. He did essentially declare mission totally accomplished. This despite the fact just a month ago, he told us that we in the market were doing the Fed's job for them by tightening financial conditions. To put things in perspective, financial conditions right now, we're all the way back to June 2022 when rates were 1.75%. So let's stop and think about that for a minute. Powell definitely discounted the whole idea of financial conditions, and maybe he's right. They're very, very volatile. But there is no doubt that wage prints have been still relatively strong. They're not consistent with 2%. We did get decent retail sales numbers. We're getting decent employment numbers. Overall, it's very hard to claim that the economy is at risk of imminent recession, certainly not after the loosening that we've seen over the last few weeks. So I would anticipate that if the Fed wanted to show any degree of caution, it might try to rein the market exuberance back just a bit in the coming weeks.
Sonal, not to beat a dead horse here, but it's just really interesting. I'm still stuck on this point that you think about on December 1st. We heard from Jerome Powell the day before the Fed's blackout period saying that it's premature to speculate about when the Fed will start to cut. And then we heard from the man yesterday saying that actually they did talk about timing at the meeting. I mean, what do you make of that? What happened in the past week and a half to cause this change of heart?
Look, I'm baffled. I would say the Fed's signaling over here is it's strange. It was just unnecessary. The market was already discounting so much. Nonetheless, they increased the number of prospective rate cuts. But beyond that, he gave such a dovish press conference. Yes, he kept saying, of course, we're looking at inflation. Of course, we're looking at inflation. But then he also kept saying how proud they were of the job they've done. And, they probably should be. But I think it wasn't super cautious. Let's put it this way. It was surprising, definitely surprising.
And I mean, to that point, it's kind of a flippant question, but it's one I've been asking. You think about the mantra, don't fight the Fed. It seems like fighting the Fed actually worked here.
Well, that's what it does seem like, but it's I have to say, Katie, I'm baffled. Why did they do this? They did something which was simply not necessary. The market was, in fact, loosening financial conditions. The market was taking care of the easing, and they have increased the quantity of easing. They clearly think inflation is going to come down substantially faster than perhaps we do. And I think it's a pretty heroic assumption. Inflation is coming down, but I'm not sure it's going to come down quite as fast as the current rate cut assumptions would suggest, or indeed the Fed statements would suggest.
Well, it will definitely be fascinating to watch this one play out. Sonal, it's great to speak with you. That is Sonal Desai. She is CIO over at Franklin Templeton Fixed Income. Now, coming up, two of the biggest names in the bond world are at odds about just how far treasuries can rally. We'll have the latest on the clash between Bill Gross and Jeffrey Gundlach.
Plus, we're going to take a look at the growth of actively managed ETFs, Katie. Brian Lake, he's global head of ETF solutions at JP Morgan Asset Management, stopping by the big program in a second.
And food delivery platforms DoorDash and Uber Eats are changing the way they ask customers for tips in New York City. We'll look at what's driving that change.
Are they still going to ask for tips?
I believe so. I think that's in the offing.
Yeah.
We'll discuss it next. This is The Close on Bloomberg. Well, the growth of active ETFs is one of the big topics at the annual ETFs in Depth conference here at Bloomberg's headquarters in New York, taking place today. Among the speakers there is Brian Lake. He is the global head of ETF solutions over at JP Morgan Asset Management. Thrilled to say he's taking the time to join us now on set. And Brian, let's start with just active ETFs in general. Of course, JP Morgan has been helping to lead the charge there. It's been one of the stories in ETFs this year, just the record share of flows that are going to these actively managed products. What do you think is behind that? Is this as simple as there's been more volatility, or is there something fundamental going on?
It's bigger than that. So ETFs are celebrating their 30-year anniversary this year. When ETFs started, it was primarily a passive story, S&P 500, Russell 1000, and then it developed. And investors started to understand that the technology of the ETF wrapper, trades throughout the day, tax efficient, low cost, transparent, was just the technology. What you put inside of it was the investment engine. And so once firms like ours started to put some of our best active capabilities in it, investors started to respond. So you nailed it. Active ETFs are accelerating. So last year, active accounted for 19% of the net flows into the ETF industry. This year, it's actually 25% of the net flows. So more and more investors are using active ETFs in their portfolios.
And so, Brian, we were in Miami in February at a different conference. It was awesome. And on the sidelines of that conference, you told me that up to $3 trillion in the next 5 years in ETF assets could be in actively managed strategies. When you think about the growth that we've seen in the months since then, is that still your call, or have you revised that up at all?
Yeah, we're still on track for that one, Katie. I appreciate you checking in with me every quarter on my my prediction there. Absolutely. So there's never been a rolling 5-year period where ETF assets haven't doubled for the last 30 years. That was true over the last 5 years. So here in the U.S., we got about $7.5 trillion in ETF assets. Now, active is only about 5 or 6% of that right now. But as I just said, it's gaining pretty significant share over the last couple of years. And so, yeah, fast forward with simple kind of math of what we've been doing for the last 20 years, and you could see the ETF industry double from kind of 7 to 14, 15 trillion dollars. And I think active could be 10 to 20% of that. So there's your $1.5 to $3 trillion in active ETFs.
In terms of asset classes, what drives that?
Yeah, that's a good question. So I think a big starter there is on the fixed income side.
Yeah.
And you know, the thing that I hear from investors is they're just underwhelmed with how fixed income indexes are constructed. A fixed income index is going to weight the heaviest debtor as the biggest component. And that's not how I or you probably think about your fixed income exposure in your portfolios. And so when you can use active management to correct for some of those things, provide that outperformance.
Well, that's where I was going, because I am curious at how you sort of crack that nut, because I mean, that kind of is the holy grail. If you can create a more efficient way of packaging that stuff in ETFs without that illiquidity risk, I guess, if you will.
Yeah, so I get in trouble with our bond people when I say bonds are clunky, but bonds can be clunky, right?
Yeah.
When you take a bond,
worry. Bond people aren't that tough.
Bond people aren't that tough. Yeah, okay. Well, they tell me they're the smartest people in the room. But when you take a bond and you give it equity-like characteristics, which is what an ETF does, you now have some magic that's happening, right? And so an active fixed income ETF, first of all, gives you active, so we've solved the kind of passive challenge, but then you get the benefits of the ETF wrapper. So now you're in bonds, you're immediately diversified, so you look at like a product like ours, like JCPB, which is our core plus bond strategy, core holding within your fixed income portfolio, owns 796 bonds. You buy one share of that, you're immediately diversified. So that's a big plus.
Yeah.
Secondly, if you were to go buy those bonds, the spread you would pay would be on average north of 50 basis points. The ETF trades at about 8 basis points wide because it's transparent and it's on exchange. So market makers are bringing that spread in really efficiently for investors to get that. And then it's really convenient to use in your portfolio. You want to add a little bit today, you just go into your trading system and you buy a couple more shares. You want to buy 63 shares, you can buy 63 shares. You want to sell 52, you can do that. It's incredibly convenient. So fixed income ETFs make up less than 1% of all bonds globally. I think that that will grow significantly because of the things that I just mentioned.
Well, Brian, we have to talk about JEPI. That is the JP Morgan Equity Premium Income ETF. It's not quite a household name, but it's almost there. I mean, it's seen 2 years of nearly record growth. It's taken in, almost $13 billion this year alone. But what's interesting, amid those just incredible inflows, it's actually underperformed the S&P 500. It's up about 9% on a total return basis. You compare that to the S&P 500, up over 20%. How are you thinking about that bid coming in, even though you are underperforming?
Yep. So I've got 3 things here, Katie. First of all, you kept your receipts on me. I kept my receipts on you. I was here in July, and I told you that JEPIC was the one to keep an eye on as well, which is JEPI's cousin on the NASDAQ 100, which has also had about $7 billion of inflows this year. But back to your question. So first of all, JEPI in 2022 outperformed its benchmark by 16% because it provided that protection to the downside. Now, we know that when you have a covered call strategy, to get that income and to get that more of that defined outcome, you may be giving up some of the upside. I don't think anybody expected the markets to go straight up 30% in the first half of this year, and what's the NASDAQ up? Almost 50% year to date, right? So that's an environment when a covered call strategy, to your point, is going to trail its benchmark. JEPI and JEPIC have done exactly what they were designed to do. It's that the markets have been in this scenario. So the real question is, well, what do we think is going to happen going forward? And so do we think the markets are going to rip straight up another 30, 40% going into next year? Or are we going to be a little bit more cautious? Now, I'm getting pretty bullish with what the Fed said yesterday and how markets are responding to that, but I don't think we're going to be in a straight up market. I think we could be a little bit range bound with some volatility. So a JEPI or a JEPIC, which can give you that 7 to 9% on JEPI or 8 to 10% on JEPIC with a little bit of downside protection, that's still a very attractive place to play, and I think that they'll continue to be strong.
I gotta say, it's easy to keep receipts when we keep having these conversations on camera. Brian, really enjoyed this. That was Brian Lake. He is Global Head of ETF Solutions at JP Morgan Asset Management. Much more ahead. This is The Close on Bloomberg. Well, what did you order the most from DoorDash this year? The delivery service, it actually revealed its most ordered items of 2023. On that list, we have fries, we have chicken quesadilla, mozzarella sticks, garlic naan, spicy chicken sandwiches, etc. Romaine, I look at this list and I just get such heartburn.
Yeah, I mean, some of that. Garlic naan, that sounds pretty delicious here. I am curious about fries being at the top.
Yeah.
Now, when they say that, is that because people order like a burger and it comes with fries, or are they specifically just ordering fries from DoorDash?
What I would also like to know.
We need to do a deeper dive
meal.
into this.
Yeah.
I mean, this is important, Katie.
Yeah.
Because, I mean, we talk about consumer spending trends. I mean, if this is really the revolution of French fries, then shouldn't we be covering that on a daily basis?
Well, let's do some on-the-ground reporting. Do you order from DoorDash?
I don't really know. It's pretty rare that we order from DoorDash for a variety of reasons. But have you seen, how they deliver those things?
In bags.
In bags, in those dirty bags.
Those potentially dirty bags.
I don't know. I'm a little bit of a germaphobe.
You could do
just go and get my own fries.
A pandemic special, spray down.
There you go. Don't forget though, you're supposed to tip them.
That's true.
Do you tip them?
I do tip.
I
do tip. On that note, this is The Close on Bloomberg.
This is the countdown to the close. Just about 30 minutes left to go here in the trading day, Katie.
And you take a look at the S&P 500 up about 0.2%. Not quite the huge rally that we saw post-Fed yesterday. Pretty much an even split if you take a look at the sector level. You can see energy up top, up by 2.8%. That's as crude stages a rally of its own. Real estate, materials as well, having a good day. Real estate, of course, as rates drop big time. You go down to the bottom of the screen. Interestingly enough, you do have tech down, so too healthcare, utilities, and then at the bottom, Romaine, we have consumer staples off by about 1.3%.
This is definitely a rate-driven rally, and we're already starting to see some of the sell-side analysts pile on. Dick Beauvais over at Odeon Capital actually upgrading several of the bank stocks, including Bank of America and PNC, saying that that drop in rates is going to be a net positive for a lot of those names. Meanwhile, Alcoa getting a phenomenal bid on the day, up about 15%. This after Western Australia actually approved that company's mining plan. Why does that matter? Well, there had been a huge regulatory overhang there as it appeared that maybe they weren't going to get that approval. We're now learning that they did through 2027. The sell-side folks over at JP Morgan raising their price target on the company over at Alcoa as well. We're going to get some earnings after the bell a little bit later tonight. Lennar got set to report earnings, also benefiting from the rate story. Those shares up about 7% here on the day, but really across the housing space, across the REIT space, you're seeing a massive rally, largely because of that drop in rates. And then keep an eye on global payments. This just crossed the Bloomberg terminal a little while ago. Our reporters, speaking with sources who didn't want to be named, said that global payments is apparently in discussions with Shift for Payments to combine. Shift for Payments shares had been halted. They just reopened up about 8%. Global Payments, though, down about 3%. A lot of overlap with these companies. Of course, both focus on merchants and small businesses in their payment platforms there. Something to keep an eye on here as to whether that drop in rates, Katie, also provides a pickup in M&A activity.
Well, let's talk a little bit more about the Fed decision and this economy with Jason Schenker. He is chairman of the Futurist Institute and the president and chief economist over at Prestige Economics. Jason has been ranked among the most accurate forecasters on the street. Thrilled to say he joins us now. And Jason, there was a lot to pick at from yesterday's press conference. I want to bring you some of Powell's comments on inflation. He made the point that so far, inflation coming down, it's come without large job losses. The Fed chair also said that he's reluctant to say that the last mile of this inflation fight will be more difficult. If you take a look at the drivers of the inflation still in the system, is that your read as well?
Absolutely. I think we look at the job situation, there's still over 8.7 million open jobs, and there's less than 1.9 million people collecting unemployment. What we had was a massive backlog of unfilled jobs in the wake of COVID, something that happened across industries and something that happened throughout the supply chain in manufacturing, where you had goods in a backlog. Well, it wasn't just goods that were backlogged, like cars or forklifts. It's also jobs across the economy that just couldn't be filled because the demand was so high. And even now, with over 8.7 million jobs, there's a lot of wiggle room, because before the 2007 recession, there were only about 4.5 million open jobs, and we have almost double that right now. So that's a really healthy job market. Before you'd see lots of job losses, that backlog, that 8.7 plus million extra jobs, that would have to run down even further before you'd start to see lots of job shedding.
And with that in mind, do you think that it's feasible that the unemployment rate will get above 4%? And the second part of that question, does it have to?
Well, it could get above 4%. That's certainly the FOMC member expectations for the end of 2024's rate, that we're going to be at the 4.1 number is the median expectations. But it doesn't have to happen that way, because we just have so many extra open jobs and so few people collecting unemployment that, you know, we might just see this really good soft landing. And that's, I think, one of the reasons you see such optimism in financial markets, especially after that most recent jobs number that surprised to the upside.
Do you have some confidence, though, that what the Fed communicated, at least, that doesn't necessarily mean they're going to cut, but the idea that they felt comfortable enough communicating that, do you have enough confidence that they will stick by that?
This is a great question because you're right, Romaine. The Fed very often communicates things that they might not do, right? We remember back in September, they were communicating there was going to be one more rate hike before the end of the year, and that didn't happen. So the fact they're communicating now that there could be 3 rate hikes by the end of next year, well, the end of next year is a long way off, Romaine. So, we'll see if that happens, but I think what it does directionally show us and reinforce is that while inflation is still a priority and rates might remain elevated, we see that the inflation situation has eased off, and they do believe there's likely to be some wiggle room to lower rates. Now, the timing of that's kind of the big question. I know some analysts are expecting it almost imminently. We don't think it's until at the earliest the mid-year of 2024, but lower rates do seem likely ahead because we are likely to see a slowing of growth. But on the job scene, things could remain relatively solid because of that surplus backlog of unfilled roles across sectors.
I'm sure, as you know, there's been a lot of anecdotal reports here about certain pain in certain pockets of the market among certain households. The idea that while some of the top line economic numbers we look at certainly look healthy, there are a lot of people out there who have already retrenched and a lot of people who are at least worried about economic conditions. Even if that worry isn't justified, the worry is there. How do you sort of factor that in the model, particularly because we're talking about something that's anecdotal and not actually hard data?
Well, if we look at some of the most important data about the health of the consumer, we look at some of the credit data we get out of the New York Fed every quarter, that household credit and debt numbers. We see that the delinquency percentages have inched up, but they're still relatively low. And there are concerns about certain areas of debt, like credit card debt. But if we look in general, most of the major pieces of the economy are still solid. And of course, US GDP driven predominantly by consumption. And here's the big secret: people with jobs spend money, and that consumption drives growth. That's why I think there is optimism for the year ahead. And if we look at things even like home prices, those are still high. Of course, there's an everything rally going on right now as well. And now we see interest rates going down, mortgage rates going down. All of those things are buoyant for the year ahead. If you were to ask me about 2024 and what I'm worried about, it would be in the latter part of the year when the election questions come up. And that's something that I think is going to be a lot more difficult to predict than when the Fed's going to cut rates.
And Jason, we don't have much time left, but I wanted to bring you something else from Jerome Powell that caught my ear. He said that this is the year when distortions from the pandemic unwound. Is it safe to say that we're actually back to normal now?
I don't think we're back to normal yet. We have 8.7+ million open jobs. That's so much more than we normally. We have almost 600,000 open manufacturing jobs. Before the last recession, we had 300,000. So you're talking about an economy that is still experiencing some distortions. We're not all the way there yet. Clearly, with core CPI at 4%, we're not back to pre-COVID levels for a lot of stuff yet. And of course, with these higher interest rates, housing, that shelter component, that's a third of core CPI, 25% of headline CPI. That's not likely to get a lot better in the near term because we've also seen construction of housing has slowed with higher interest rates. So that could keep some of those shelter costs high. And of course, apartment vacancy rates are still at the lowest pre-COVID levels since the mid-80s.
All right, Jason, got to leave it there. Really enjoyed this conversation. That is Jason Schenker of Prestige Economics. Now coming up, it's the top 3, where we focus in on the top 3 movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg. All right, it's time now for the top 3. Every day at this time, we do a deep dive into the people at the center of today's top stories. Joining us now is Scarlett Fu. Scarlett, who are you watching?
I'm watching the one and only Beyonce. The singer's Renaissance World Tour has increased her net worth to somewhere in the neighborhood of $800 million, according to Forbes. She made about $100 million after taxes from her tour. Her music catalog is worth about $300 million. And then she has all these other assets, including real estate, art, and her business holdings with Jay-Z.
Yeah, and it's interesting. And this is mostly the net worth, mostly her earnings. I guess some of this is kind of the joint earnings. I guess.
Well, they split it up into two, so they counted her part.
They counted her part.
Yeah.
I guess that's it. So that's pretty good, right?
I'd say
I
so.
do wonder, though. We talk about how much money she made this year off of the back of that tour here. How much that changes, if assuming she doesn't do much next year. I assume she's not doing another world tour. Maybe she is.
I don't know. I would love to ask her, but hopefully she'll put some of that money in an index fund and it'll compound over time, et cetera. Maybe
that's her pitch to her.
Yeah,
I guess
maybe
so.
how
Index
about
funds.
a triple leverage ETF
Triple
that's
leverage
focused on
cash, as Tom Keene would say.
I'm sure she's got pretty good financial advisors, or you would
so.
hope so. I was also keeping an eye on another person. In fact, two people, believe it or not. A lot of talk about the drop that we've been seeing in interest rates. Jeff Gundlach over at Double Line telling CNBC he actually expects to see rates go down to 3%. Meanwhile, Bill Gross, the former bond king, saying that's farcical. He actually says that basically where we're at right now on the 10-year. I put that in quotes. He said farcical. And so the idea is that where we're at right now with the 10-year yield, which is basically right below 4%, he said that's pretty much where we need to be.
And I just love that this is playing out over X, formerly known as Twitter, of course. Gundlach on CNBC, Bill Gross on Twitter taking a shot there. But Gundlach's reasoning is interesting. Basically, he sees the Fed likely to cut rates by a full 2 percentage points next year, which I shudder to think what that would take.
One interesting thing about this debate, because I feel like they're not actually arguing about the same thing. Because in all seriousness, I mean, Gundlach's position is much more focused on economic fundamentals. And I don't think Bill Gross really went as far down that road. I mean, he's dismissing it. But the idea is Gundlach is making an economic case as to why yields will go down to 3%. I think Gross is stopping short of that, saying mostly this is technical driven and where we're at is where
But we're the media, so we're going to pit them against each other.
Oh, absolutely. Absolutely. And they're more than welcome. I mean, we can set up a cage right here on the set, and we're more than welcome to have it on and duke it out.
Yeah, and of course, we'll keep receipts. We'll take stock of this bet. But let's also talk about Oprah, because
Gross, he looks like he's scrappy, right? Like, I mean, I know he's a little older, but I feel like he's somebody you don't want to mess with.
I don't think I'd want to fight either of them. I definitely wouldn't want to fight Oprah. And the reason we're talking about her is because she said in an interview with People magazine, she's taking a weight loss drug. She says she's taking it as a maintenance tool. Now, she didn't specify
as a what?
A maintenance tool. She didn't say which drug she's actually taking. And that would have been interesting to see if the stock reacted at all.
Yeah, I was actually, that was the first thing that jumped out at me, because as soon as she would name the company, then it was just like probably
it's
take
like a
off
book
like
club
a rocket.
mention.
But she's probably holding out for, the board seat or endorsement or whatever. And then she'll be like, oh yeah, I love my Novo Nordisk, whatever. What did they make? I got them all confused.
Let's not put words into her mouth just yet. She did say, though, it's a combination of diet, exercise, and medication that's helped her slim down in recent years.
Okay, Scarlett, that's me rolling
Romaine
my
is
eyes.
rolling his eyes at this.
All right, coming up here after the break, a conversation about the markets with Sinead Colton-Grant over at BNY Mellon Wealth Management. Stick with us. This is A Close on Bloomberg. This is the countdown to the close. Romaine Bostic here alongside Scarlett Fu. With 10 minutes until the closing bell, we are getting a bit of an extension of the rally from yesterday, though we should point out the complexion of it is completely tilted right now to small and mid-cap stocks.
Yeah, I mean, the everything rally largely was extended before it lost a little bit of steam. But as you mentioned, the Russell 2000 still fired up 2.6%. It's now higher for 5 of the last 6 trading sessions. And I was just checking the sector breakdown there. Everything but staples, classic defensive sector, is gaining. And of course, you look at the 10-year yield breaking below 4%, a pretty swift move, because in late October, it was above 5%. As recently as a month ago, it was at 4.44%. Of course, the dollar is where you're seeing the first stage of how a Fed pivot gets priced in. It is coming down quite a bit.
Absolutely. And we're looking at yields right now on the 10-year and the 5-year below 4% for the first time since July. The rest of the curve also shifting lower, raising a lot of questions here about whether investors should shift as well. Sinead Colton-Grant joining us right now, BNY Mellon Wealth Management's head of investor and solutions, and pretty soon she will be the chief investment officer. Sinead, great to have you here on the program. And we got to talk about this drop in rates. I know the last couple of days have been extreme, to say the least, but there has been a trend over the last few weeks of investors really starting to price in this idea that rates need to be lower, or at least meaningful lower than where they were a few months ago here. Is it premature to start rethinking portfolio allocations based on that drop in rates?
Great question, Romaine, and delighted to be here. So I think we got an early holiday present yesterday from the Fed, and we've clearly seen the reaction in markets. Our outlook for 2024 is for a healthy slowdown, and in other words, that magical soft landing. Yields have been coming down for a while now as we've started to see markets want to price more about cuts next year, and we're seeing the softening data. Right now, they've probably got a little bit too much priced in. Now, following the press conference yesterday, 6 rate cuts before the end of the year. That's probably a little bit overdone. Yes, yields will probably move lower, but for the end of 2024, we think the 10-year yield ends up 375 to 425. But here's the thing. You asked about portfolios.
Right.
Absolutely, investors should be looking at their portfolios today. This is what we're talking to a lot of our clients about, because we're in an environment where some bonds will generate something that's close to a 6% return on a tax equivalent basis. That's very close to an equity-like return. You don't see that very often. So it means in portfolios, you could potentially reach your goals, but you take less risk to do so. So it's actually really exciting for investors.
Yeah, absolutely. And I just want to go back to one fine point with regards to where rates might go here, because there's this idea of rates of the Fed funds rate that is coming down here. But does it need to come down that fast? I mean, if it does come down within 12 months, whether it's 4 25-point rate cuts or 6, that would still be relatively rapid, and it would seem to suggest that there is something wrong with the economy if they went that fast. Or is that the wrong way to look at it?
That is a great observation, and that's exactly our concern. So when we think about the Fed rate cuts, it's probably in the region of 2 to 3 by the end of next year. If you look at what markets are pricing, our concern would be that means a rapidly slowing economy, and potentially we're talking about recession, not a soft landing.
So when we talk about a Fed pivot, the markets are pricing it in rapidly, clearly, as we talk about the possibility of 6 rate cuts. But how long does it take to actually filter through the real economy?
Typically, you see it's about 12 to 18 months, right, for the impact of rates to start coming through. And if you go back to when the Fed actually started hiking, we're pretty much at that 18-month mark now. And we're seeing the slowing, right? We're seeing a slightly softer labor market. We've seen huge progress on inflation.
Right, but for the rate hikes to filter through, it takes about 12 to 18 months. How about rate cuts? Does it take just as long, or does that go by faster?
It's sector by sector dependent, but typically we see the economy start to respond to that a little bit faster. Look at the housing market, for example. One of the reasons why the housing market has been something of an unusual indicator this time around, prices have remained very buoyant because there's so little supply, because anyone who's locked into a mortgage rate that's 3% or lower, they're going nowhere. They're not moving. So we don't have enough supply. The difference this time around is probably as you start to see rates move a little bit lower, mortgage rates come down to maybe the 5s, you see a little bit more supply in the housing market. But sector-wise, we start to see the impact of rate cuts a little bit more quickly. We talked about small and mid-cap.
Yeah.
Very interest rate sensitive, typically more interest rate sensitive than large cap. So it's not surprising that today we're seeing the follow through on small and mid-cap.
Absolutely. And this gets us, I want to go back, kind of circle back to the idea of portfolio planning and portfolio strategy. If there is all that money on the sidelines, the dry powder that we've been talking about all year, do you think that moves, when people to get confidence to come off the sideline, that moves into riskier type assets, or do you think that will flow maybe more into fixed income or even into private capital, which at least on a risk-adjusted basis might look a little bit more attractive than equities?
Well, let me tell you the 3 questions that our clients are asking us at the moment. The first is, should I be moving out of cash? The second is it too late to get into bonds? And the third is, are US stocks going to continue their rally? And look, I think what we know is that as we move into a rate cutting cycle, cash underperforms, and particularly for a taxable investor. Bonds have rallied, yes, yields are lower, but they're still the highest that they've been in a decade, so this is still pretty attractive. And finally, on equities, we do think the US equity performance exceptionalism continues. It's in part because generally US stocks are, particularly in the large cap space, they're in better financial condition. They also lean more heavily into technology, AI, which we think is going to be a big productivity boost in the future. And private markets absolutely attractive because you get the illiquidity premium. And for most investors, for the equity portion of their portfolio today, they need private market exposure to be to have exposure to those companies that are in the high growth phase before they go public.
Yeah. You mentioned earlier that clients are pretty pleased with what they saw in November. Given all of that buoyancy, what is the risk of bubble formation across different assets?
I would not use the word bubble, but I think particularly as we've seen more positive returns following the press conference, the danger here is that we're borrowing some of the returns from Q1 of next year in terms of equity market performance. Look, if rates are going to be cut at the pace that the market is pricing in, it's of course supportive of asset markets.
All right, Sinead, always wonderful to talk to you and get your insights. And if we don't see you before the end of the year, have a wonderful holiday season. Sinead Colton-Grant over at BNY Mellon Wealth Management, helping us count down to the closing bell. Scarlett, we're just about 2.5 minutes away from that here. And of course, the big outperformer remains the Russell 2000 and the small caps, and the S&P holding on to fractional gains.
Holding on to fractional gains, but you look at the volume. Trading volume is up about 60-70% from the 20-day average for both the Dow, S&P, and NASDAQ.
All right, stick with us. We are moving closer to those closing bells. Our full market coverage coming up right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bosick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Tim Stenovic and Emily Grafale. Welcome to our audiences across our Bloomberg platforms, radio, television, as well as our partnership with YouTube here. An extension of the rally here, Tim, in the equity space, but that is tilted pretty heavily to the small, mid caps and cyclical stocks, which I think would be kind of welcome for a lot of investors.
Yeah, it's kind of the tone from our markets guest this afternoon is that this broadening out of the rally that we're seeing, sort of moving away from the, quote unquote, magnificent seven. We're finally starting to see some breadth here. We're finally starting to see those folks who've been kind of left behind in this massive rally, at least in the tech names and in the indices. And that's good news for stock investors, and also stock pickers like to tell us it's good news for stock pickers, Emily, because they're the ones who, in this environment, they say, can find those ones that continue to move higher.
I'm thinking of one stock picker who's having a good day, Kathy Wood. You look at the ARK Innovation ETF up 3.8%. That speculative tech trade still rallying, even though we see these indexes starting to come off from the fervor that we saw yesterday. Scarlett.
Yeah, I'm just looking through the different asset classes to see what's not participating in this gain. The dollar, for one, the dollar is weaker versus all the G10 and the major currencies, but across the commodity complex, it's all green arrows all around.
Yeah, definitely so here. As the rates drop, and of course the drop in dollar sort of fuels all this, and you look at sort of the resurgence in a lot of those interest rate sensitive sectors. You of course have the traditional ones like REITs, but you look at the bid coming into meme stocks. You look at the bid coming into a lot of those energy stocks, which are of course also tied to that, as well as in the real estate space as well, which I think I just said. Anyway, let's walk you through the closing bells here on this Thursday afternoon. A Dow Jones Industrial Average pushing to another record high, up about 160 points or 0.4% here on the day. Modest gains for the S&P 500, just about 0.3%, but now right around that 4720 level, and now just about 70 points or so away from a fresh all-time high. The NASDAQ Composite higher on the day by about 0.2%. We should point out the NASDAQ 100 at one point did trade at a record high, though that's going to finish in the red on the day, down by about 0.1%. And let's take a look at the Russell 2000, because that was the outperformer here on the day, a 53-point gain on the day, 2.7%. And you just add up the differential with the broader market here, and you're talking about one of the biggest outperformances that index has had versus the broader market all year long.
Yeah, the Russell 2000 certainly the star of the day. If we peel back the layers of the S&P 500 and take a look at what moved higher, what moved lower, Scarlett, we had 328 stocks advance in the S&P 500. We had 174 move lower, kind of equally split on the Dow. 16 moved higher, 14 moved lower. Scarlett.
Yeah, on the New York Stock Exchange, more than 3 stocks gaining for every one that declined. Let's take a look at the different sector performances here. You've got autos in the lead, gaining more than 5%, and believe it or not, Tesla is the smallest gainer in that group. Within the banks, all 15 members rose, and energy stocks getting a big lift with oil prices rising as well. The decliners of note are insurance companies, off by more than 3%, household and personal products, and software and services led by Adobe.
Well, let's take a look at some of the gainers. No shortage of companies to find a highlight here. Let's start with shares of Moderna, among the best performers on a points basis, or percentage basis, I should say, in the S&P 500 today. Finishing the day up more than 9%. Shares soared after a new study showed that a personalized vaccine that was developed by Moderna and Merck actually helped prevent a resurgence of severe skin cancer for 3 years. Some details of the study include that patients with severe melanomas who got the vaccine and Merck's cancer drug Keytruda were 49% less likely to die or have their cancer return than those who got Keytruda alone, the company said on Thursday. So some great news when it comes to advancements there. And also some really good news for Moderna, whose shares have been under pressure this year in the wake of less than ideal uptake for the company when it comes to new COVID vaccines. I want to go to Rivian. Scarlett, you talked about shares of auto companies being higher today. Look at Rivian, up close to 14%. We learned today of a pilot deal with AT&T for an order of commercial van R1 vehicles. Have you guys seen the Amazon Rivian vans making deliveries around New York City?
Yes, you can't miss them.
Yeah, they're all over Brooklyn. And because, I'm really interested in these cars and what they do, I always ask the drivers what they think of them. I've gotten like universal, unanimous feedback that they love them. And they're actually kind of fun looking too, and they're very quiet.
You can't miss them,
well.
that's the thing.
Yeah, they got like the big smiley faces on the back, which they kind of look like people. It's kind of funny. Clean energy stocks too, also surging on the day today. Let's take a look at the iShares Global Clean Energy ETF. It's ticker ICLN, finishing the day up close to 5%. This follows the performance of the S&P 500 Global Clean Energy Index. You got companies in here like First Solar, finishing the day up more than 8%, Enphase Energy up more than 12%, SolarEdge Technologies up around 17%. Interest rate sensitive stocks, clean energy stocks are, and investors are certainly happy that the Fed seemed to indicate yesterday that they were at or near their peak when it came to those interest rates, Emily.
Well, like Scarlett said, Adobe is leading a lot of the market lower today. We have those shares down. The worst intraday decline since February, down 6.4%. They give a full year forecast that was weaker than expected on a number of key metrics. And they also disclosed that the U.S. FTC has been investigating the company's subscription cancellation practices for more than a year. The FTC really wants to make it as easy as buying a subscription to anything, a membership, an online cable subscription, as easy as it is to buy as it is to cancel. So Adobe, I guess, coming under some pressure there. I'm also looking at Cardinal Health, those shares falling as much as 6.9%. Wells Fargo began coverage of the drug distributor, and they gave it an underweight rating. We also saw Piers McKesson falling because in this coverage note, Wells Fargo said that it's really hard to argue for near-term upside for the sector while these kinds of stocks have had an amazing run. Earnings growth is likely to moderate over the next few quarters, and Wells Fargo is more cautious on the sustainability of some of these tailwinds. I wonder if he wrote that note before or after the Fed meeting. I'd be curious because there's a lot of tailwinds in the market, at least right now for some stocks. And also Global Payments was down as well, as much as 7%. This is a fintech company that is weighing an acquisition of Shift4 Payments, Inc., according to people with knowledge of the matter. Atlanta-based Global Payments has been working with an advisor to study the feasibility of this deal. This is all according to people who asked to not be identified discussing confidential information. So Global Payments down, but Shift4 was in the green today. Scarlett.
Yeah, interesting moves that we've been seeing in some of those individual names. And we take a look at what's going on in the yield space. That 30 basis point drop that we saw in the 2-year yield yesterday, extending just a bit on the day, down by about 5 basis points here. And of course, nowhere near what we saw yesterday. But you see the trend line that is down 4.4 right now on your 2-year yield. And you take a look at your 10-year yield. We're now down below 4% for the first time going back to July. And quite frankly, at 3.9 and change. And at one point on the day, we actually traded below that as well. Your 5-year also below the 4% mark, and the 20-year and 30-year drifting down to that level as well, as everyone now is not only pricing in rate cuts, but really just pricing in a whole shift in the rate regime. And you're seeing that yield curve shift all the way to the downside. And it raises a lot of questions as to what, I guess, the next catalyst is going to be. I mean, this is it. We get a little bit more economic data. Last time I checked, there's no more earnings, or at least I hope not. And the Fed is pretty much out of the picture until their next meeting at the end of January.
Well, yeah, but at the same time, it's going to take a while for people to shift their portfolios to get money off of the sidelines. And it's notable that the Bank of England and the ECB did not follow the Fed in pivoting. So it feels like the U.S. is the only game in town when it comes to the different assets denominated in dollars.
I think one of the next catalysts could be before, and we're not too far from hearing from the banks in early January. I remember it is always earnings season. But what about this close to $6 trillion that's just sitting there in money market funds? If we indeed start to see the yield on, those money market funds move lower as a result of these lower interest rates, where does that money go? Does it go into the bond market or does it go into the equity market? And if it goes into the equity market at these levels, what actual effect does it have on the equity market? Where exactly does it go? That's what I'm watching.
Yeah, and I mean, Tim, there's a lot of people, a lot of guests on this show who were talking about how they wanted to extend duration, and they kind of missed the boat if they were trying to do that, trying to lock in those higher treasury yields. They've already come down so much in the last 24 hours. I imagine if we do see a pickup in yields, we're likely to see any of those bond bulls just kind of get right into the market, hoping to not miss out on any more.
But it raises the question, too, does it have to go into equities? I mean, you talk to the private equity and private capital guys, I should say, and they all think it's all going to flow to them. And, of course, even folks in fixed income say, well, it's all just going to stay in the bond market. It'll just move from the shortest to short term to longest. So everybody has this wishful thinking here. But what is the case for equities? I mean, I know some of the rally that we've had today is directly tied to that drop in rates. But, I mean, there has to still be some fundamental story. And is that there?
It was a question that I posed to really our guests throughout the last 24 hours because there is so much money there. But Andrew Cry.
How many guests do you have in an hour?
We have 3 guests per hour. Okay. How many guests do you have per hour?
6.
Yeah, 6, 7.
6 or 7.
Yeah, we go
we beat you.
We go long with our interviews. Okay. Andrew Cry, the co-chief investment officer over at Crescent Grove Advisors, Scarlett, he said that with the broadening out, there is still room when it comes to individual stocks. He was again a stock picker, so he's interested in talking his book a little bit here. But I think we're going to be hearing a lot of that with the broadening out of the rally. Like, okay, hey, we know the stocks that are going to move higher. The easy money is gone with the indices moving higher, the Magnificent Seven moving higher, having such a good year. We know the stocks that are going to be moving higher moving forward.
Yeah, all those beaten up names, all those names in the small cap space, all those that have a lot of debt but have held on so far, they look a little bit differently now.
They certainly do. Hey, we got to go. But don't worry, because we're going to be back with you in less than 24 hours for our next simulcast. That does it for this one, though. Beyond the Bell.
Do you just stay there, or do you leave?
I sleep here, actually. Yeah. Which is fine. We got everything here.
There's a carpet.
Yeah.
There's food upstairs.
That's actually all I need. That is going to do it for our cross-platform coverage of the market close here on Bloomberg TV and radio, Bloomberg Originals, and YouTube. Catch us tomorrow, same time, same place.
And stick with us here on Bloomberg Television. Our coverage continues on the close with a focus on the hottest topic of the year, artificial intelligence and the ethics behind it. Paula Goldman, Chief Ethical and Humane Use Officer over at Salesforce. She's up next, right here on the close. This is Bloomberg. Another interesting day in U.S. markets, a rates-driven rally, and you saw that play out in a big way in the small caps. The differential between what the Russell 2000 did on the day, a more than 2% gain, and the S&P 500, which just had a 0.2% gain here. But this is the broadening out of the rally that a lot of folks wanted to see, and maybe, just maybe, they're finally going to get it. Whether that actually stays, whether it actually continues into next year remains to be seen. But you can see on the board here with the Magnificent Seven, the big laggard on the day, believe it or not, and a lot of the stocks that really are dependent on lower interest rates moving higher. That includes some of the meme stocks like a Carvana, like a GameStop. It includes a lot of those renewable energy stocks like Sunrun, and of course includes a lot of folks in the banking sector. In fact, a big upgrade today by Dick Beauvais over at ODM Capital that really sees some good times ahead, at least for some of the bigger mega banks as well as some of the bigger regionals. Meanwhile, you take a look at some of the other movers on the day. A 2-year yield down about 4 to 5 basis points on the day, coming off that 30 basis point drop that we saw yesterday. Again, weakness in the dollar, which actually works in favor of equities in this environment, and a very curious move higher in crude oil, though after we were talking a little bit earlier with some of our guests here on the show, say a lot of that is much more driven by tax losses and some of the technicals rather than any fundamental shift in how people view the supply-demand equation in the oil market. All right, let's talk about the big story of the year. And our apologies to the Fed, our apologies to Wegovy. The big story of the year really was artificial intelligence. Just about a year ago, that's when it came to the attention of a lot of folks, and it really took us by storm. And it raised a lot of questions about how AI can be used ethically and in a way that avoids bias. Our next guest does just that. She is going to discuss some of the lessons she's learned from her 5 years of advocating for ethical tech at Salesforce. Paula Goldman is the Chief Ethical and Humane Use Officer at Salesforce. And we should point out, before she got there, she had several years of doing this on her own for other companies as well as her own ventures. And I'm pleased to have you here, Paula.
Oh, great to be here.
You know more about this than most people here. And I do want to start off here first with Salesforce. This is roughly the 5-year anniversary of the creation of your office, effectively. And we should point out, for most people, we didn't even start talking about AI until about a year ago. So what was going on in those 4 years prior to this that the rest of us all seem to miss?
Well, AI is not new,
Yeah.
right? It's been around for a while. Salesforce has been working on it for more than a decade. And, you know, credit to Salesforce leadership, because I think they foresaw that we're going to have to navigate a bunch of ethical issues. And we spent the last 5 years really laying down a set of guardrails, a set of policies, processes to make sure that we could build AI with trust at the center.
As you know, we cover companies in here, effectively capitalism. And it's amazing how many companies come on and they don't want to talk about ethics or things like that because in their mind, it has nothing to do with how they make money or what investors want out of it. What was the thought process behind Salesforce setting up something like this? Why did they feel a need to do it?
Well, I'll give you an example from right now, right? When you think about AI for the enterprise, which is where Salesforce plays, we sell to businesses. Trust is the #1 question. It's not an afterthought. It's what unlocks innovation. So our customers are asking us, how do I make sure my data is secure? How do I know where it's going, that it's not being used to train third-party models, that we're not going to have toxicity in the results and the like? And the answers to all of those questions are key to us being successful in the market.
You talk about creating a framework to build and deploy ethical technology. There's a number of officials like you, humane use officers, ethical officers across the industry. Do you guys work together? How much best practice sharing is there between you and your colleagues?
No, quite a lot. Salesforce was early in this, but it's very heartening to see that there's increasingly a cohort of people working on responsible AI across the industry. And we get together a lot, and especially these days, right? Because it's very important that we're not only talking to each other, but that we're talking to governments, civil society. It's a place where I think a rising tide lifts all boats.
Right, and you need to create standards that everyone understands and everyone has agreed to the parameters of. So I'm curious, how did the drama over at OpenAI, which in many ways at the end of it resembled just any basic corporate drama, how did that contribute to the average person's understanding of responsible technology? Or maybe it took away from it?
Good question, and it's great to see that things seem to have settled down, and that we, you know, at Salesforce, we have a number of partners that we work with in this regard. I feel like what is coming to the fore right now, and it's very gratifying, is people are understanding that there are big questions we need to address and that we need a sort of whole of society approach on it. That's why it's great that governments are paying attention. It's great that companies have functions like mine, because we need to be operationalizing this almost in a similar way as we did for cyber 20 years ago. It becomes a discipline by which we build software.
What did you make of that kind of framework that the EU effectively agreed on? And I know it's still a long way coming before we get other countries on board here, but do you see that as the potential, I guess, skeleton for a much broader global model in regulation and oversight of AI?
Yeah, we were really excited to see the political agreement on the EU AI Act this last week. And I think what's great about that is that it takes a risk-based approach to regulation, right? So it really says it's not just about the models in AI, it's about the use cases, the apps that are built for particular end uses. And it's saying, let's take the riskiest ones of those and make sure there are standards across the board. I think that's a big step forward.
This gets to this idea, too, that you know, everyone always thinks that regulators and politicians are behind when it comes to technology. They're always behind the curve. They don't quite understand this. Interesting you mentioned the cyber agreement. And I know in the past there's been a lot of efforts to sort of create better regulations smarter regulations, I should say, for the internet overall writ large here. Do you think that what is being lobbied and communicated by the industry to these politicians in the U.S. and abroad is getting through in a way that we are going to end up with something that is constructive and not necessarily debilitating to the growth of AI and what it can do.
Yeah, I'm very optimistic about it. You know, I gave you my comments on the AI Act, but it's also great to see roundtables happening all the time with regulators, and great, you know, from the UK to the US to Australia and beyond. And so I do think this is a moment where also people recognize that these guardrails are critical to unlock innovation.
It's great that we're having these conversations and the debate and the discussions continue. Who is someone that you think is a real leader, is a thought leader that people should be paying attention to and really heeding as this conversation continues?
Well, I'm privileged to sit on the National AI Advisory Committee, which was set up by Congress to advise the president. I would advise people to look at the list of people that serve there because they're from civil society, from companies, from lots of different places in society. Great list of people to look at.
Was there one name on there that stuck out at you?
I'm going to
putting you on the spot.
Yeah, our chair, Miriam Vogel, who leads a nonprofit called Equal AI, and that's all about making sure that AI is representative of the people it serves, which couldn't be more important.
All right, Paula, really appreciate this conversation. Appreciate you coming in town for a big Salesforce event. Paula Goldman there, she's the Chief Ethical and Humane Use Officer over at Salesforce. Scarlett?
All right, we have Costco earnings that have just come out. We can never say enough. They're still earnings. It's still earnings season. And first quarter total revenue of $57.8 billion does top the average analyst estimate of $57.7 billion. First quarter EPS also higher than expected, $3.58. And Costco has announced a special cash dividend of $15 a share. So the stock moving up just slightly in after hours trade, even as the first quarter comparable sales in the U.S. does appear to trail the average analyst estimate. This is The Close on Bloomberg. Costco just reported results just a few moments ago, and what we can tell you is that total revenue and profit beat analyst estimates for the quarter ended. However, comparable sales in the first quarter, when you back out gas and currency, trailed the average analyst estimate, 2.6% versus the expected 3.5%. Let's bring in now Bloomberg's head of U.S. consumer, John Edwards. And John, some of this might be tied to, of course, slowing demand from the consumer overall, and also disinflation of prices. Is this a theme that we're seeing across retail?
Yeah, I mean, it's definitely something that people are looking out for. And, you know, Walmart made some comments about, you know, that they weren't necessarily seeing it, but they were watching for it, you know, in certain categories, dry grocery included. So, you know, Costco, with its mix of grocery and, you know, goods sales is, you know, one place that we might start to see that trend show up. And it does look, you know, from the light comp sales, like, you know, it's possible that that's sort of feeding in there.
How does that fit in with the retail sales numbers that we got today for the month that ended in terms of lower prices and slowing demand? I know that November is a hard month to gauge because people are out there holiday shopping.
Yeah, exactly. I mean, retail sales were surprisingly strong, and I think some of that probably had to do with the lower gas prices. You know, people feeling a little more flush, maybe getting out there and spending a little more than we expected, honestly, you know, because they have a little more in their pockets. But you know, overall, you know, it looks like the consumer, you know, is remaining fairly resilient. You know, we've been saying that for a long time, and it's, you know, it's still happening.
Does it matter, though, that this still kind of, the spending trends still kind of tilt to services and experiences rather than goods, or does that not really matter?
I mean, it certainly matters, and especially to companies that you know, offer more goods than services. But you know, I think you know, in terms of you know, certainly recession possibilities, that looks you know, pushed a little farther out than people had.
And then you have like those retailers that now are offering services. They're they put a bar or a coffee shop in there.
Exactly.
I don't know if they actually make money
Where's
off that,
this
but like Ralph Lauren, all
sure.
go to Walk on Madison
Ralph's
Avenue,
Coffee,
you'll find a lot of them.
We've been very interested.
It's for the spouses who are sitting there.
And then I'm curious about when we talk about this idea of, do they still need to really get people into the stores? I know we've talked a lot about this idea of the omni-channel, whatever the phrase is here. But is there still sort of this need that these retailers have to get people physically there, or do they think they can make a viable business by being, I guess, e-commerce first?
Yeah, I mean, I think they definitely want to keep seeing that faster growth in e-commerce, and they want to keep pulling as many costs out of the e-commerce side as they can. That's been a concern. So they do like the fact that when people come to the stores, they're doing essentially their own delivery. So stores are definitely still a major part of
by the way, I like
major
this
channel.
here. Is this new?
Thank you.
And I like the blue combination.
Thanks very much. Yeah,
good.
it's not that new, but it is.
Okay.
Compliment for Romaine on your clothing.
No, it's not a compliment. I'm just jealous.
Oh.
So it's called envy, Scarlett.
Got it.
I like yours too, though.
I got to ask you
John.
about appliances, big ticket items. I went to Best Buy the other week and saw that they had flat screen TVs for $350, 50 inches. I mean, this is unheard of from a couple years ago when it would be a couple thousand. What did that look like in November? Because this is the time when people are going to splash out for those big items, buy someone a big TV, right?
Right. Yeah, but there's it's still been a struggle to get those big ticket items moving. I think people are being more selective in what they're buying, and also they stocked up on a lot of those major purchases during the pandemic. There was a lot of home renovations, a lot of home improvements, and so you don't need another refrigerator or even another TV necessarily if you just bought one a year or two ago. So yeah.
Is there any sense, though, that some of the gains that we've seen in terms of retail sales overall, that is going to continue into 2024? I mean, I know some of the conference calls we've had so far seem to suggest that's the case. But are you finding that to be true?
Yeah, well, I think, it'll be interesting to see how this sort of disinflation, slash deflation idea plays out. Because if we do start to see, real improvements in prices in some categories, that could keep people spending a little more. And then there is still the support from very high employment. So, as long as people are, out there working and bringing money in, they are going to still keep spending it.
All right, John Edwards, a closer look at the retail space on the back of those Costco earnings crossing the wire. We're still on watch right now for additional earnings, believe it or not, out of Lennar here. So a closer look at the home building sector coming up in just a little bit. We're also going to talk to Michael Baker, D.A. Davidson, Senior Research Analyst as well. Stick with us. This is The Close on Bloomberg. The U.S. equity rally lives on for another day with the S&P, the Dow, and the NASDAQ composite all moving higher here on the day. But that was really outlapped in a big way by the small caps and the cyclicals. Dow Transport's up more than 1% here on the day. S&P 400 mid caps up more than 2%, and the Russell 2000 almost reaching a 3% gain here on the day, and that was largely on the back of that continued drop in yields, the 30 basis point drop on the 2-year yield yesterday. You add to that another 4 to 5 basis points here, and we're significantly lower than where we were just a week ago. Most people are betting that trend line does continue into the new year, a trend line now that has a lot of people looking past 4% and even as far down as 3% here. But that raises the big question, Scarlett, what exactly is going to drive that? A drive down to 3%, is that going to be based on deteriorating economic fundamentals, or more just a normalizing of what the Fed is doing and where it wants that neutral rate to be? A big determinant of that, of course, is going to be the labor market, and it's going to be the pace of consumer spending.
Yeah, and it would be a rapid drop, too, given that we're at 5% at the end of October as well. All right, of course, we'll keep an eye on those developments. In the meantime, let's get you caught up to date on Costco, which did report earnings a few moments ago. First quarter EPS and total revenue beating analyst estimates, but comparable sales in the U.S. for the first quarter, when you back out gas and currency, did trail analyst estimates, up 2.6% versus the expected 3.5%. Let's bring in Michael Baker, Senior Research Analyst at D.A. Davidson. Michael, can you make sense of that for us? First quarter comparable sales looks like they trail analyst estimates, even as the overall number topped the consensus.
Yeah, I'm not that worried about the consensus, really, because remember, Costco reports monthly numbers. So the consensus should have been largely, or the numbers should have been largely known. Frankly, we had 2.6 in our model. So I just think it's a case of maybe some people not catching up with their models, but they had already reported sales for the 12 weeks. So really no real surprise there, except that again, maybe some of the estimates were stale. I will say the membership fee income did come in slightly below consensus estimates. Still a very strong number, up 8%. That is a good number, but that was slightly below consensus estimates. That number wasn't known. But overall, I think the top line was fine. The other highlights in the quarter is the gross margin was actually really strong, and that's what led to the earnings beat. So I think it's a good report in terms of new information. Again, understanding that the sales were primarily known already.
Okay, well, let's talk about the membership for a moment here, because there's expectation that Costco will increase annual fees in 2024. How much does that add to gross margin and to profitability? Because there's no real cost tied to raising that membership fee, is there?
Correct. There isn't. It falls straight to the bottom line because of the accounting and the way memberships roll off. It sort of accrues over a 24-month period once they do it, and we think they will do it in 2024. It ends up being about a 2.5% to 3% enhancement to EBITDA or EBIT to the bottom line. So it's not massive, but it is helpful, certainly, and it is largely expected. It's been about 6.5 years since they've done it, and they usually do it every 5.5 years. I think they didn't want to do it in 2023 with the consumer battling inflation. It probably would have felt a little tone deaf in a way, but with that sort of moving to the background, we do suspect it'll happen this year. There were really two predictions we had for Costco in terms of those types of things. One was they will raise dividends. The other one we think thought for 2024 was that they would do a special dividend. I guess they beat us by a couple weeks here announcing that today, but I would say that's not a huge surprise that they did that special dividend today.
I'm curious as to how you view some of the other retailers in this space, whether they're direct competitors or maybe just peripheral competitors here. If we are headed into a year where most people think we're going to have a relatively stable economy with the added benefit of having lower rates and ideally lower inflation as well here, is this going to be one of those rising tides lifts all boats, or should investors be much more hyper-focused on individual names?
Yeah, I think the discretionary names will probably outperform better in 2024. And again, we put out our 2024 outlook piece earlier this week. We call it a Baker's Dozen predictions for next year. So 13 predictions, and one of them is just that the more discretionary, higher beta, risk on, however you want to term it, we do think those names will outperform. So a name like Costco, we think if the market's up, the stock will probably be up, but we don't think it'll be up as much as some of the more discretionary type retailers that frankly underperformed in 2023 when Costco outperformed. So we think that reverses next year.
When we always talk about Costco, or at least certainly earlier this year when it looked like economic conditions were deteriorating, there was all this chatter about how they were going to be the beneficiaries because people trade down, or at least they are search for discounts, and obviously you can find that relatively easy at a Costco here. Does, I guess, better economic conditions work against them at all?
Well, again, I would only say it works against them in a relative sense. So their comps will be better in a better environment, and the margins will be better because you'll be buying more discretionary items. So in that sense, it helps Costco. But if you look at the results in a year where it's more discretionary, for instance, if we think that'll be 2024 compared to 2023, the delta isn't going to be as large as it might be for a really discretionary retailer like, let's say, Best Buy or something like that was negative. It will end up being negative in 2023 and could flip to positive. So the rising tide in that sense will lift all boats. Some boats will be lifted a little bit higher, we think.
All right, Michael, great to talk to you. Michael Baker over at D.A. Davidson helping us break down Costco's earnings here, 358 on that EPS number. And, of course, that's on the back of pretty healthy growth in comp sales. We are getting earnings crossing the wire on Lennar, the home builder, which, of course, just earlier today closed at a record high. Those shares down in after-hours trading after their fiscal fourth quarter adjusted EPS did beat expectations at $5.17 a share. The street was looking for $4.60. We should also point out that in the revenue side of the picture, you had $10.97 billion in fourth quarter revenue. The street was looking for $10.34. So a beat on those two metrics for the fiscal fourth quarter. Looking forward to the fiscal first quarter here, the company is saying that deliveries will also come in above expectations, about 16,000 to 17,000 deliveries for the quarter here. And the company also says new orders will also come in above expectations at about 17,500 to 18,000. Drew Redding joining us right now. He's Bloomberg Intelligence's home builders analyst. And Drew, let's get right to it here. I mean, this is a stock that's been on a run, and we should point out the whole home building group as a whole is right now trading at a record high here. The initial reaction that we're seeing in the shares, is that more just a function of the fact that the shares have rallied so much?
Well, it looks like on the order front, orders were a little bit stronger than expected. It looks like a little bit light on the gross margin, both in 4Q and looking forward. What you have to remember is Lennar's business model calls for them to drive volume sales. So they've been pretty upfront with investors that they're going to drive volume and the gross margin is going to be the shock absorber. So to the extent that they have to issue financing incentives, rate buy downs to hit those volume numbers, that's what they're going to do. And if you look at what they guided to for 2024 deliveries, it's about 10% growth, and that's what they guided to last quarter. So the question now is, with rates coming back in, what's going to be the cost of that growth? And we think that there could be a benefit to margins with rates coming down because they're less likely to have to incentivize as much.
Yeah, and Scarlett, and just to clarify for our viewers, that gross margin number did actually miss a little bit at 24.2%, and also looking at that backlog number, also a miss as well.
So, and that might be one reason why the stock is falling. It's curious then, given the numbers overall that were better than expected, if it is the margin number that's driving the negative reaction in the stock right now, what's your take?
Yeah, I think it's definitely the gross margin. And like I mentioned, that's an area of the income statement where they're willing to make a sacrifice in order to drive volumes. But like we mentioned, if rates are coming back down, to the low 6.5% range is kind of where we're thinking about next year. And that requires them to reduce the amount of interest rate buy downs they're doing, because typically in this market, they found that the 5.5% range is where they need to get their buyers, and not just them, but the public builders as a whole, to really get some excitement going and build some demand. So to the extent that they don't have to pay as much for those rate buy downs, we think there could be some upside to margin. So there could be a little bit conservatism going forward.
How do they stack up, though, against some of their competitors? I know a lot of these companies, we kind of lump all these home builders into the same space, and I know a lot of them sort of compete for different customers along the income spectrum and geographics as well here. Where does Lennar sort of fit in that landscape?
Sure. So Lennar is a little bit different. They're one of the two largest builders, along with D.R. Horton, in the country. And those are really the only two that have any scale at the national level. So their market share at the national level, double digits, far exceeds some of their smaller peers. And that really gives them the opportunity to get access to land deals that maybe some of their smaller peers aren't getting. It allows them to consolidate trade labor, it allows them to do bulk purchasing. And we think that scale is really what helps them drive stronger gross margin. And we think going into next year, as they continue to take market share, it's really going to be that scale that helps them.
True. Really appreciate your joining us and giving us the instant analysis on Lennar's results. Lennar currently falling in after-hours trading after its latest quarterly results. We talked about mortgage rates falling. They're now at about 6.8%, according to Freddie Mac, below 7%, so bringing some much-needed relief to the housing market. Yet, the damage over affordability may have already been done. At least that's the case for Generation Z. Allison Schrager, Bloomberg opinion columnist, writes, just as millennials are entering middle age, they are locked in cheap housing. The outlook is not so good for Gen Z. Allison joins us now for more on why that's the case. So, Allison, you're saying that despite a lot of complaints by millennials that housing has worked out badly for them, that everything was unaffordable for them because they had so much student loan debt, they actually came out okay.
Yeah, I mean, it is true that millennials are sort of slower to grow up, although that's for a lot of reasons. But as like other generations, as they reach their 30s, they did start buying homes the way, other generations had. And those prime home buying years were also coincided with some of the most cheapest mortgages that we'd ever seen. So while prices were higher, and that is a legitimate complaint, they also had much cheaper mortgages than prior generations. For instance, their parents would have been facing 8, maybe even 12% mortgages. So in the end, they actually ended up doing okay. And while they don't own homes quite at the same rate their parents did at the same age, they're not that far behind.
Yeah, that's interesting because there's been so much ink spilled on this idea that millennials are more likely to not be able to leave their family's embrace, right? They end up having to live at home for longer because of all these costs. The data doesn't always bear that out.
Well, that is true. I mean, where really we find the difference is fewer millennials leaving home. But that is largely men who without college degrees. So actually, the odds of owning a home increase the more student debt you have, just because people with a lot of student debt tend to have gone to graduate school and they tend to earn a lot more. So what?
I'm sorry, go on.
So there is certainly millennials who are being left behind, but they're not the ones with student debt. They tend to, as I said, have a lot of other issues and actually tend to have less education.
I'm curious though too. I mean, we kind of always pit the millennials versus the boomers, and everyone hates the boomers. I get it, but there's this sense that maybe that's been a little bit overdone. Obviously, the boomers had kind of probably the most ideal conditions that we've had in the last century in terms of economic opportunities here. But it's not like people today, whether it's millennials, whether it's Gen Z, et cetera, like they don't also have some very unique and sensible opportunities in this economic space here. Is there a sense here that when we look back on this 30 years from now, we're like kind of, just taking jabs at the next generation below us here, that we'll look back on this and realize that this was all nonsense?
Well, to some degree, this is as old as time. I think when people complain, they have a legitimate reason to complain. I think becoming a financially secure adult who's a homeowner and forms a family and doesn't feel financial stress is a genuinely hard thing. And when you look back, I recently did this writings in the 80s, you hear millennials having the same complaints, and everyone has a point there. It is a genuinely hard thing. I do think it is actually going to be genuinely a little harder for Gen Z than earlier generations because they're being hit with high mortgage rates and high prices.
Yeah.
And because so many people locked in cheap mortgages in the last 3 years, we're not going to have the same supply. I mean, you will have some people who have to move in, but it won't be the same level of supply that other people had. So they get hit with a double whammy, which is actually a little unusual.
I get that. And I don't mean to be morbid, but also a lot of these boomers are going to start to pass off and in theory pass down some of those assets that all these millennials are so envious of. How does that factor into the equation?
Well, that should probably help some. But again, that has happened in other generations too. I think what is unique about Gen Z is they face this very strange, I think people are estimating that this sort of strange housing market where people just really can't afford to move could last like a decade. And that is a little more unusual. But I think like other generations, Gen Z will eventually figure it out, make a go of it. Maybe they'll face some really great economic shocks from AI or, who knows what the future holds. I think it is true they'll have a hard time like everyone, but maybe something good is in store.
Yeah. Well, I guess you ended on a high note there. Allison, always great to talk to you. You're a national treasure, by the way. I love reading your columns. Allison Schrager, Bloomberg Opinion columnist here. A great column today. Taking a closer look at Generation Z getting a bad deal on housing. Coming up here, a closer look at the outlook for private debt in the year ahead. Amanda Lyman going to be joining us, head of macro credit research over at BlackRock. This is The Close on Bloomberg. With just about 2.5 weeks left in 2023, let's look ahead to 2024 and particularly the outlook for debt markets. Competition growing between traditional banks as well as private credit. Amanda Lynham joining us right now, head of macro credit research over at BlackRock, to talk a little bit about the trends. And let's just go back to the start of this year where everybody was talking about the rise in interest rates and, more importantly, the higher cost of capital and how that was just going to kill off private capital, kill off private equity and private credit. Of course, we can laugh about it now because we know nothing like that happened. I do wonder, heading into 2024, should we now be reversing that narrative and talking about what lower interest rates means for them going forward?
Thank you, Romaine and Scarlett, for having me. I think I would say from a broad perspective, we don't think that the higher cost of capital adjustment is complete. Even with the recent retracement in rates, we still have a cost of capital that's structurally above what we've been used to in the post-financial crisis era. So I think corporates will continue to need to adjust to that, and really investors should be emphasizing corporates, and that's both in the public and private market, that have the pricing power to navigate that. As it relates to the private debt markets, I think one of the really important factors, in addition to the higher cost of capital environment, is the flexibility that those firms have in terms of their long-term lending relationships between the borrowers and the lenders. That is something that we expect to be a benefit going forward. As you mentioned, the cost of capital pressures have eased, but they've not been eliminated. And so I do think that for private market investors in general, really emphasizing that credit selection, that granularity, that opportunity for structural protections, and then of course the flexibility that comes with a long-term lending relationship will be very valuable.
So has the sentiment and the caution that we saw this year, has that actually improved?
I think it has, not necessarily just because of the recent price action from yesterday's FOMC, which has obviously caused a rally across risk assets, not just even debt. But I think it's actually improved for two reasons. One is the loss performance that we continue to see flow through, and the most recent data that we have is as of the third quarter, really underscores the resilience of that private debt asset class. There are two indices that we track, the Cliffwater Direct Lending Index and the Lincoln International Senior Debt Index. The Cliffwater Index losses are normalizing, but they're still very, very modest in the context of the overall income generation of the index. And then with the Lincoln International Index, the covenant default rate in private debt has actually been declining for 2 consecutive quarters, which is a bit of a counterintuitive result given the higher cost of capital that you mentioned. So I think that's really the driving force of investors, perhaps increased optimism with respect to the resilience of this asset class. Of course, if we do get some rate relief, that's a benefit, but that's a benefit, I think, across the credit markets broadly, not just for private debt.
You mentioned the FOMC and, of course, what happened yesterday, sending everything into a risk rally. What did Jay Powell's comments, or perhaps what did he not say, that might change the parameters of what you're projecting for 2024?
That's right, Scarlett. So I think the key takeaway from my perspective is that it seemed like Chair Powell was really embracing the potential that they might do proactive rate cuts really to calibrate the real interest rate. There's been a lot of focus in the market's timing of when these rate cuts happen. What we've emphasized is that the reason for the rate cut really matters. So if it's a proactive cut to get ahead of a decline in inflation and normalizing and calibrating real rates, we view that as really supportive for risk assets. I think prior to yesterday, I didn't think that that was a high likelihood. Chair Powell's comments really did seem to embrace that to a certain degree. If we get rate cuts, however, because of a downside risk to economic activity, that I would view as a more negative outcome for risk assets. So in addition to the timing of when those rate cuts start, we're going to be watching very closely for why these rate cuts are happening. Our base case heading into yesterday's FOMC was that rate cuts in the first half were unlikely and that they were more likely in the second half. What we wrote in our weekly today is that it sounded like the Fed's language and the chair's language yesterday skewed those risks towards earlier cuts.
Right.
But again, we're more focused on the reason as opposed to the timing.
Thank you for clarifying that. I think that's a really important context for people to consider. I'm wondering also how you're thinking about the prospect of increased scrutiny and regulation on private loans. The SEC has been doing more to get hedge funds and private asset firms to comply with some of its disclosure rules. How big a risk is that in your space?
Sure. I think with any large asset class, there's always a healthy amount of regulation and scrutiny on it. The one point that I would note as an observation is that kind of going back to the March 2023 regional banking sector disruption, really the asset liability mismatch of the banking system was something that investors were really focused on. And I would compare that to the private markets where that asset liability matching is much more congruent between the investor's lending horizon and the investment itself. And so I think what March showed us is that lending long and borrowing short, which sometimes happens in the banking system, can be a vulnerability in certain market environments, whereas in the private markets, often that capital is left up for years.
All right, Amanda, great stuff. Amanda Lynham there over at BlackRock. Appreciate her time. Stick with us. We'll be back in a moment. This is Bloomberg. Looking ahead to what the markets will be watching over the next 24 hours, data out of China.
Yeah, we've got a lot of it. We've got industrial production, we've got retail sales, we've got home prices, we've got the lending facility rate, all to see what exactly is going on inside China.
We're going to get PMI data as well. And all day tomorrow, Scarlett, I know you've been following this. EU leaders will gather in Brussels for their last summit of the year.
There's going to be a lot of hand-wringing over Ukraine.
All right, a lot to cover tomorrow. Please tune in. In the meantime, stick around. Balance of Power is coming up next here in the U.S. This is Bloomberg.